Well, here the Fed decides, John, we've got to look at the data as the yield market does a little bit of a walk to a higher yield structure.
Yields pushing higher, Tom, and it's all been about the front end to the belly of the curve for this Federal Reserve since September 22nd, the last time they met. Into the belly, 5 years up, 6 basis points now to 1.2%. The two just short of 50 basis points. We breached that in the last week. I think we should question the connection between monetary policy and financial conditions. And the reason I ask that, and the reason I think we should ask that question repeatedly, in economic history, in recent economic history, Tom, one of the frothiest markets we've ever seen was approaching 2007. And through that, over the few years into that, we had higher interest rates, Tom. Interest rates were climbing through all of that, and risk appetite kept piling on and piling on and piling on. And I do think we should question this idea that you go instantly from pulling back on QE to introducing higher interest rates and financial conditions just immediately tightening and equities falling from all-time highs. Because, Tom, in history, we've seen examples again and again, in fact, where it doesn't play out that way.
Scott, what I find so interesting here, Scott Minard with us as well, is that Michigan, even with their loss to Michigan State and Diane Swank learning there about savings, you understand savings is a murky and a mysterious thing here. Scott Minard, how do you respond to the reality of the excess savings within our system?
Well, I think, Tom, what we really have here, and I think there are two elements to this excess savings. There is the excess savings that we're measuring, and then there's the home price appreciation that has built up in people who have homes and who can tap that appreciation for future consumption. And so I think this is giving us a real cushion on the consumption side, that this savings will either slowly get spent directly or indirectly through investment. And I think we just basically have the fuel to keep a bull market going.
Diane Swank, we have a moonshot in the banks noted moments ago by the Keefe-Bruyette Bank Index, which is, folks, very good mathematics describing the American banking system. Diane Swank, is this Fed policy a policy of the financial elites as we see within the KBW index?
Well, actually, what the Fed is trying to do is favor, as Lisa pointed out earlier in the show, they're trying to make the lesser of the two mistakes and trying to allow the economy to catch up and reemploy those workers who lost their jobs. And there's lots of frictions in doing that. And they're willing to overshoot a bit on inflation, and asset prices are on the side of that in order to allow that catch up. Ultimately, though, inflation, and I think one of the things that gets lost in translation, and Scott really hit the nail on the head with the issue of equity in people's homes. I do think we're going to see the saving rate, which in September dipped to 7.5%, almost pre-crisis levels, go lower as people tap into their home equity lines of credit. The bad news is that those workers who lost all their unemployment insurance and all the supplements and the things that had kept them afloat, that had also helped juice some underlying demand, that savings will be gone by the end of this year. And it really gets to the inequality issues out there. And this Fed has really focused on trying to get employment back as an equalizer, even though, unfortunately, their tools tend to stoke asset prices faster and more rapidly than they get employment going again in the middle of, as you rightly pointed out, a pandemic. The course of the virus still determines the course of this economy, as we saw in the third quarter. And I think that's very important to remember.
Scott, I do want to go back to what you were talking about earlier in the show, flicking at the potential for recession in the upcoming years. What's the trigger, given some of the strength that we're seeing and the dovish tone out of the Fed?
Well, I mean, our work shows that when you get forward rates to invert, and we've done work on this that shows that for the first time since 2006, we're getting there again. Well, actually, we did get there too in 2016 and 17 and 18. This is the stuff that tells you that you're probably looking at the first straw in the wind of a recession that's 2 to 3 years out. Now, it's interesting, the causality. There are two ways to get there. One is an exogenous shock, which is the kind of thing we had with the pandemic. The other way is to just start to see a slow erosion within the economy. So, let me give you an example. An exogenous shock right now will be a spillover from the property crisis in China. The other route is, of course, that as we've been talking, and the economy starts to lose momentum because inflation doesn't come down, and that's real growth isn't reaching the levels we have, and the Fed is tightening, then all of a sudden, it's the straw that breaks the camel's back. And I think that where that moment comes, whether it's the exogenous shock or it's just the burnout of the economy, is where the Fed is going to have its greatest challenge, because it's going to have to choose between an inflation rate which may be higher than what they're targeting at 2%, versus taking the risk that would be related to a collapse in asset prices, which would potentially be devastating to the financial system.
Scott, let's war game this out right now. Let's say everything you just said could be true. In 3 years, you get a recession. In fact, I'm going to guarantee you one right now. Let's play the game. You've got one in 3 years.
Right.
What would you do differently tomorrow? How would you change your capital allocation decisions?
Well, Jonathan, right now I would stick with the risk-on trade. It's interesting. You made the point a few minutes ago about rising interest rates historically have actually been good for stock markets because it shows that there's growth in the economy and there's confidence. So, I think that the initial phase of rising rates, you stick with the risk-on trade, but you start to look for indicators. And one of my favorite indicators of a recession is, 3 successive negative prints of leading economic indicators. We're far away from seeing that right now, but that I would be long until I started to see those kinds of signals.
You've touched on the hot button issue, and Dan Swank, I think you're perfect to answer this question. If we need to hike interest rates anytime soon, is it for good reason? Is it for good reason, or is it the EM dilemma that we're responding to? Is it for good reason?
That's a great question, and we just don't know. And I think there's a really interesting issue here, too, is that all of the rate hikes that you cite that the market ended up doing well through were the Fed being preemptive about a non-existent inflation, not the Fed chasing inflation. And I think that's one of the things that's a different dynamic. And I would add on to one other way we could get a recession, in addition to rate hikes, is that we could have this bullwhip effect on supply chains. People are double ordering right now. By the time we get into the end of 2022, 2023, we could have an unwanted rise in inventories as demand normalizes or even cools a bit in response to rate hikes, and that could trigger a more traditional inventory-led recession. This is a more of a boom-bust cycle kind of scenario, and it's very different than anything we've seen since the early 1980s.
But let's wrap in here, Diane Swank, and you're such a student of this with the National Association for Business Economics. Our present politics, with this chairman, maybe he has a job next year, maybe not, all wraps around inequality. Nothing shows that better than the expansion of a 25-year Keefe-Bruyette index, which shows a moonshot for the haves, a moonshot for the elites. Can we sustain that?
No, and it's not good for the economy. I mean, this is one of the things that the Fed, racism and the economy events have all been about, and the Fed has been looking at, and it's why they're trying to hedge on this side of allowing the economy to grow, because what they realize is the latter part of the expansion, they were wrong in 2018 by preempting a non-existent inflation, and by allowing the unemployment rate to drop lower, they got to narrow the unemployment rate between black and whites, and that was really important because an economy that works for all is a bigger economy for all as well. It increases the size of the economic pie. But that's really hard to do as we're going forward in here, because not only did the pandemic expose many of these inequalities, it also exacerbated them. If you own a home, you've got a lot of equity. If you don't, you're having a hard time paying rent right now.
Lisa, this is so important, and the Keefe-Bruyette index shows that on radio it's very clear here. You've got the crash of 07, 08, 09, a recovery, and then the fiscal moonshot, Lisa Abramowitz, that we've seen off this pandemic.
Yeah, and the idea that some of these banks have not been lending as much as they would like to because of that fiscal moonshot. And I wonder, Scott, as we get the bleed off from that fiscal support, how we view which constituent we really emphasize here. In other words, can the Fed really meaningfully support the economy if it doesn't get hiking quickly and soon?
Well, I mean, look, what the Fed is doing is something that the Fed was never designed to do. The Fed was designed in 1913 for the purposes of providing liquidity in moments of crisis, not to deal with income inequality. And, to Diane's point, I think that that this attempt to use the Fed is creating another level of inequality, which is wealth inequality. And, the haves and the have-nots, and that gap in our society is the sort of thing that you see that precedes, like, the French Revolution. So, this is very politically divisive, and I think that it's very difficult in an environment like this to get ourselves back on track with so much inequality in the system.
Scott and Diane, the news conference about 3 or 4 minutes away. Just a final question for you both on all of this. Is Chairman Powell the chair of this Federal Reserve this time next year? Diane, is he?
I think he will be. I think it would be a wise idea to just go ahead and keep the continuity at a time when uncertainty is so high. That said, who knows? But I think Chairman Powell will be Federal Reserve Chair a year from now.
Scott, final word to you on that.
Well, I think the wisdom Diane expresses is correct. I think, however, it won't be that he won't be the chair because the populist wing of the party, Elizabeth Warren, has made it very clear that she does not want this man in charge.
Scott Minerd, thank you, sir. Diane Swonk of Grant Thornton. Scott Minerd of Guggenheim going into this Federal Reserve news conference in about 2 minutes' time. Tom, there's going to be a question on that in the news conference, There's got to be. The future of Chairman Powell.
Yeah, Mike McKee's rude enough to ask the question, and maybe there'll be somebody else there that will ask it. I do agree, John. You made a point earlier, which I'm too polite to bring up, and, you bring up the impolite fact is how does he amend and adjust to these realities? And the answer is he doesn't. He's going to play it straight. But coming off the election, John, and with Murphy ahead right now, 15,000 votes in New Jersey, for all of these people in Washington, the calculus changed last night.
Yep, I've had a few people reach out to me as this show has progressed, Lisa, who have suggested that the wings of the progressives have been clipped,
yes,
which should encourage a decision to renominate Chairman Powell.
The issue, though, and this is actually a question I hope gets asked, how do they ensure continuity? How do they ensure a vision that can get carried through to next year if that uncertainty as to who will be at the helm persists?
They've done this before, and they'll figure it out. They'll change the curtains, decide what's new to eat for lunch.
It's different this time, Tom. Honestly, this is a different kind of scenario with such binary types of outcomes and the potential risk being literally opposite depending on who you speak with.
If you're running a business or an institution, when you're at an inflection point, Tom, a change in leadership often isn't the wisest move, is it?
Well, that's what we heard from Diane Swank.
The strategy to lead the strategy.
Yeah, don't listen to me. Listen to Diane Swank, and she made very clear this continuity is going to be there. This is a president that is buffeted, to say the least. And, the real question to me, John, does he make some headlines and make this decision in the next 14 days? Or does he wait? And that's a real point of discussion.
Or does the chairman make the decision for him, Tom? That one could be interesting as well. Chairman Powell is about 30 seconds away, and here's the price action going into that news conference. We look at a little something like this in the equity market. Equities are up 1/10%, all-time highs, and a fifth day of gains on the S&P 500. Your bond market looks a little something like this. You got the $15 billion taper announcement you were looking for. Yields are higher by 4 basis points on 10s, up by 3 basis points on 30, 198 on 30s, 159 on 10s. But the focus of the street is going to be on the front end into the belly of the curve, up 3 basis points on 2s at 48 basis points. Here is the chairman of the Federal Reserve.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support. In the third quarter, real GDP growth slowed notably from this rapid pace. The summer's surge in COVID cases from the Delta variant has held back the recovery in the sectors most adversely affected by the pandemic, including travel and leisure. Activity has also been restrained by supply constraints and bottlenecks, notably in the motor vehicle industry. As a result, both household spending and business investment flattened out last quarter. Nonetheless, aggregate demand has been very strong this year, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. With COVID case counts receding further and progress on vaccinations, economic growth should pick up this quarter, resulting in strong growth for the year as a whole. Conditions in the labor market have continued to improve, and demand for workers remains very strong. As with overall economic activity, the pace of improvement slowed with the rise in COVID cases. In August and September, job gains averaged 280,000 per month, down from an average of about 1 million jobs per month in June and July. The slowdown has been concentrated in sectors most sensitive to the pandemic, including leisure and hospitality and education. The unemployment rate was 4.8% in September. This figure understates the shortfall in employment, particularly as participation in the labor market remains subdued. Some of the softness in participation likely reflects the aging of the population and retirements. But participation for prime-aged individuals also remains well below pre-pandemic levels, in part reflecting factors related to the pandemic, such as caregiving needs and ongoing concerns about the virus. As a result, employers are having difficulties filling job openings. These impediments to labor supply should diminish with further progress on containing the virus, supporting gains in employment and economic activity. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. Despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. The supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. In particular, bottlenecks and supply chain disruptions are limiting how quickly production can respond to the rebound in demand in the near term. As a result, overall inflation is running well above our 2% longer-run goal. Supply constraints have been larger and longer lasting than anticipated. Nonetheless, it remains the case that the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, specifically the effects on supply and demand from the shutdown, the uneven reopening, and the ongoing effects of the virus itself. We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer-run goal. Of course, it is very difficult to predict the persistence of supply constraints or their effects on inflation. Global supply chains are complex. They will return to normal function, but the timing of that is highly uncertain. We are committed to our longer-run goal of 2% inflation and to having longer-term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer-term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability early in the pandemic, and since then have helped foster smooth market functioning and accommodative financial conditions to support the economy. Last December, the committee stated its intention to continue asset purchases at a pace of at least $120 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. At today's meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the Federal Reserve Bank of New York prior to our December FOMC meeting. If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Hi, Nick Timmeros of the Wall Street Journal. Chair Powell, the markets anticipate you will raise rates once or twice next year. Are they wrong?
So, I would say it this way. We try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected ways. So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So what I will tell you is we'll be watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Well, based on, if I could follow up, based on your current outlook for the labor market, do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Hi, Chair Powell. I was wondering if you could detail a little bit how you're thinking about wages at this moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields. I wonder if you see that as a positive thing or as a potential start to a wage price spiral, and sort of how you sort of delineate those two things.
So wages have been moving up strongly, very strongly. And in particular, I would point to the employment compensation index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to maybe not increasing, but close to back to zero in terms of the real increase. So wages moving up, of course, is how standard of living increases over the years for generation upon generation. It's very important, and it's generally a good thing. The concern is a somewhat unusual case where if wages were to be rising persistently and materially above inflation and productivity gains, that could put upward pressure on or downward pressure on margins and cause companies to their employers really to raise prices as a result, and you can find yourself in what we used to call a wage price spiral. We don't have evidence of that yet. Productivity's been very high. The ECI reading is just one reading. Again, if you look back, so we'll be watching this carefully, but I would say that at this point we don't see troubling increases in wages, and we don't expect those to emerge, but we'll be watching carefully.
Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody. Are we at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not sure I totally got your first question, but I would say, in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off. But in this situation, we do have a provision in our statement on longer run goals, as you know, that says when those two things are in tension, what we do is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year. We see well into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become really a threat should it create a threat of more persistent longer-term inflation. And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.
Thank you. Next, we'll go to Colby Smith at the Financial Times.
Thank you. Chair Powell, what are the economic conditions that would perhaps warrant a faster pace of tapering? And I'm wondering how you would also characterize the risks that the Fed may actually need to accelerate that process eventually. Thank you.
So I guess, as I said in my opening remarks, assuming the economy performs broadly as expected, the committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, and we're prepared to deviate from that path if warranted by changes in the economic outlook. So I'm not going to give you a lot more detail on what that might be. Of course, if we do see something like that happening, if it becomes a question, then we'll communicate very transparently and openly about that. But I'm just going to leave it with the words that are in the statement. Sorry, was there a second part?
Yeah, it's just on characterizing the risks that you might actually have to do so later on.
You know, I would just leave you with the words we have here. We are prepared to speed up or slow down the pace of reductions in asset purchases if it's warranted by changes in the economic outlook. And again, if we feel like something like that's happening, then we'll be very transparent about it. We wouldn't want to surprise markets. We'll say, in light of this factor or these factors, we are considering doing this, and then we would either do it or not do it. But but I'm not going to start making up examples of what that might be today. Thanks.
Thank you.
Next, we'll go to Rachel Siegel at the Washington Post.
Hi, Chair Powell. Thank you so much for taking our questions. You mentioned at the beginning that the Fed understands the difficulties that high inflation poses for individuals and families, especially those with limited means. What is your message to those families or consumers that are struggling with higher prices right now? And do you feel that your expectations around transitory inflation that message is reaching them? Thank you.
Yeah, so first of all, it is our job and we accept responsibility and accountability for inflation in the medium term. We're accountable to Congress and to the American people for maximum employment and price stability. The level of inflation we have right now is not at all consistent with price stability. By the way, we're also not at maximum employment, as I mentioned. So I would want to assure people that we will use our tools as appropriate to get inflation under control. We don't think it's a good time to raise interest rates, though, because we want to see the labor market heal further. And we have very good reason to think that will happen as the Delta variant declines, which it's doing now. As I mentioned, so transitory is a word that people have had different understandings of. For some, it carries a sense of short-lived. And that's there's a real time component measured in months, or let's say. Really, for us, what transitory has meant is that if something is transitory, it will not leave behind it permanently or very persistently higher inflation. So that's why we took a step back from transitory. We said expected to be transitory, first of all, to show uncertainty around that. We've always said that, by the way, in other contexts. We just hadn't done it in the statement. But also to acknowledge, really, that it means different things to different people. And then we added some language to really explain more what we're talking about in paragraph 2 and paragraph 3. We said it's particularly people who are living paycheck to paycheck or we're seeing higher grocery costs, higher gasoline costs. When the winter comes, higher heating costs for their homes. We understand completely what they're going through. And,
and other Fed officials talked about getting back to the back. Is there something short of that that would work? Thank you.
So, thank. So, maximum employment is it's a broad-based and inclusive goal that's not directly measurable and changes over time due to various factors. You can't specify a specific goal. So it's taking into account quite a broad range of things, and of course, employment levels of employment, participation. How does participation react in that world, in that? And I think the learning for those of us who live through
Schneider at Reuters.
Thanks, and thanks for doing this. So given that answer about employment, I would like to get back to Steve's question a little bit. On a headline basis, just as it's evolved this year, do you feel that the two tests on inflation have been met?
Sorry, the two tests?
The two tests in the statement, the guidance that it has to hit 2% and be on track to moderately be above it for 2%. Has the economy cleared that?
That's a decision for the committee. I would put it to you this way. When we reach maximum employment, when we reach a state where labor market conditions are at maximum employment in the committee's judgment, it's very possible that the inflation test will already be met. We're aware that language sounds a little out of touch with what's going on, but we're not at maximum employment. When that is the case, we'll look to see whether the inflation test is met. And there's a good chance that it will be if you look at how inflation has evolved in the last year and a half.
So to follow up, so you're not willing to commit that the current levels of inflation and their persistence have met moderately and for some time. So given that, I mean, how should we render what moderately and moderately over and for some time mean?
What I'm really saying is that question is not before us right now. We had the question on when to taper. We've now answered that question and the speed of it and all that. We have not focused on whether we meet the liftoff test because we don't meet the liftoff test now because we're not at maximum employment. What I'm saying is, given where inflation is and where it's projected to be, let's say we do meet the maximum employment test. Then the question for the committee at that time will be, has the inflation test been met? And I don't want to get ahead of the committee on that, but the answer may very well be yes, it's been met. But we're not asking that question today because we're not running the liftoff test. We're not evaluating the liftoff test today. We didn't have that discussion at today's meeting. We did talk about the economy and the development of the economy, but we didn't ask ourselves whether the liftoff test is met because it's clearly not met on the maximum employment side.
Thank you.
Thank you. Let's go to Matthew Boesler at Bloomberg.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So when you're looking at this question of assessing whether or not the U.S. economy is at maximum employment, do you have a framework for making that judgment that is independent of what inflation is doing? And if not, does it kind of complicate that assessment given all of the uncertainty about inflation right now and the inclination to believe that the high inflation we're seeing is not related to capacity utilization in the labor market? Thank you.
So we don't actually define maximum employment as we define it in terms of inflation, but of course there is a connection there. Maximum employment has to be a level that is consistent with stable prices. But that's not really how we think about it. We think about maximum employment as looking at a broad range of things. You can't just look at, unlike inflation, where you can have a number. But with maximum employment, you could be in a situation hypothetically where the unemployment rate is low, but there are many people who are out of the labor force and will come back in, and so you wouldn't really be at maximum employment because there's this group that isn't counted as unemployed. So we look at a range of things, and the thing is, by many measures, we are at a very tight labor market. I mentioned quits and job openings and wages and things like. Many of them are signaling a tight labor market, but the issue is how persistent is that? Because you have people who are held out of the labor market, of their own. They're holding themselves out of the labor market because of caretaking needs or because of fear of COVID or for whatever reason. They're staying out. And it's clear that there are, with tremendous demand for workers and wages moving up, it does seem like we're set up to go back to a higher job creation. So that would suggest that you're not at maximum employment. So at the end of the day, it is a judgment thing. But of course, at the end of the day, it also has to be a level of employment that's consistent with price stability.
And if I could just follow up briefly, you've talked a little bit about this possibility that the two goals might be in tension and how you would have to balance those two things. Could you talk a little bit about what the Fed's process for balancing those two goals would be in the event that, say, come next year, you decide there's a serious risk of persistent inflationary pressures despite ongoing employment shortfalls?
Yeah, I mean, again, it's a risk management thing. It's not. I can't reduce it to an equation, but also ultimately, it's about risk management. So you want to be in a position to act to cover the full range of plausible outcomes, not just the base case. And in this case, the risk is skewed. For now, it appears to be skewed toward higher inflation. So we need to be in a position to act in case it becomes necessary to do so or appropriate to do so, and we think we will be. So that's how we're thinking about it. And I think, though, that judgmentally too, it's appropriate to be patient. It's appropriate for us to see what the labor market and what the economy look like when they heal further. We know that we were on a path to a different place, as I mentioned, when Delta arrived, and Delta stopped job creation. It stopped that transition away from a goods-focused economy where there's excess demand for goods because their services are not available, people are not traveling. That transition itself could help bring inflation down because presumably people would spend a little less on goods while they start spending more on travel and all sorts of travel services and things like that. So that we want to see that healthy process unfold as we decide what the true state of the economy is. And we think it will evolve in a way that will mean lower inflation. Bottlenecks should be abating. We start to see that now with some of them, but overall they haven't gotten better overall, and we're very aware of that. So that's really how we're thinking about it. We're thinking that time will tell us more. In the meantime, we don't think it's time to raise rates now. If we do conclude that it's necessary to do so, then we'll be patient, but we won't hesitate.
Thank you. Let's go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman, for taking the call. So the Federal Reserve, I want to talk about climate change. The Federal Reserve released a statement today, says the Federal Reserve supports the efforts to identify key issues and potential solutions for the climate-related challenges most relevant to central banks and supervisory outcomes. Is this putting us on the path to regulate what banks can offer loans on or invest in, like coal plants or fossil fuels?
So that's not a decision for bank regulators or for any agency. That's a decision for elected representatives. So we feel that any role that we have, and we do think we have a role in climate change, it relates to our existing mandates. And our existing mandates are really prudential regulation of financial institutions. We expect them, and the public will expect us to expect them to understand and be in a position to manage their risks. So that's physical risk and it's transition risk for climate. And by the way, the large financial institutions are doing this already, and we think that's right within our mandate. There's also a financial stability question, the overall stability of the financial system. And so from that standpoint, we can do research. We can try to help understand what will the pathways be through which climate change affects the economy, both physical risk and transition risk. That's what we can do, and that's what we will do, and we'll do it well within the frame of our existing mandates. We'll do it well. We're not the people who will decide the national strategy on climate change. That has to be elected people, and not so much us. But we feel like we have that narrow mandate, and we will do it well.
Thank you.
Great. Thank you. Victoria Guida at Politico.
Hi, Chair Powell. So the Fed recently announced that there's going to be new conflict of interest rules for investments by Fed officials. And this follows, obviously, the resignation of 2 regional Fed presidents. And I'm just wondering, do you think that there's more that you will need to do to rebuild the credibility of the Fed, such as, requiring officials to put their assets in blind trusts? And also, if you could speak to whether you have any concerns that any rules or laws were broken by Fed officials. Thank you.
So let me just say that this system, the ethics system we had in place, had been in place for decades, and had, as far as we know, served us well. And then that was no longer the case. And so we had no moment of denial about that. As a group, we stepped in and we took the actions that we took. And within one FOMC cycle, we announced a new set of rules to try to put us back where we need to be, which is we need to have the complete trust of the American people that we're working in their interest all the time. Absolutely critical to our work, as it is for any government agency. And I feel like this called that into question. So we reacted. I would characterize it strongly and forcefully. If there were other things that we could do that were reasonable, we would certainly do them. So you asked about blind trusts. The overall authority for ethics around these issues in the federal government is the Office of Government Ethics, OGE, and they have a long-held position which is not favorable to blind trusts. They do not encourage them. They don't think they're effective. They think they're cumbersome, and they think there are better ways to get at the things that need to be done, and those are the things that we're actually doing. So I don't know that there are any blind trusts for that reason, because they're the regulator. They say this on their website if you look. In terms of laws broken, I asked the Inspector General to look to see whether there were rules broken and whether there were laws broken, and I won't speculate on that. But that is with the Inspector General now, and of course, out of my hands.
Thank you. We'll go to Mike McKee at Bloomberg.
Mr. Chairman, the critics of your patience policy argue that given the long and variable lags with which monetary policy works, that you are likely to end up, given inflation, by having to raise rates faster and farther than you would have liked and therefore send the economy into recession. Given the fact that basically your forecast has been chasing inflation over the last year, and now you're talking about it not coming down till the second or third quarter, why would they be wrong in thinking that?
Well, so let me say what's happened, and we're very, very straightforward about it, is that inflation has come in higher than expected, and bottlenecks have been more persistent and more prevalent. We see that just like everybody else does, and we see that they're now on track to persist well into next year. That was not expected by us, not expected by other macro forecasters. Now, let me say, it's difficult enough to just forecast the economy in normal times. When you're talking about, global supply chains in turmoil, it's a whole different thing. And you're talking about a pandemic that's holding people out of the labor force for reasons that we can sample, but we don't have a lot of experience with this. So it's very, very difficult to forecast and not easy to set policy. So we have to set policy, though. So that's what we're doing. And, so to look at your question this way, I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes. And that's what we need to do. I do think it would be premature to raise rates today. That's not, I don't think that's controversial. Certainly, I don't know anyone arguing for that today. And the reason is that there's still ground to cover to get to maximum employment. And we don't want to stop that when there's good reason to think. There's still good reason to think, although it's been delayed. Clearly, there's good reason to think that the economy will reopen, particularly if we do get past, significant outbreaks of COVID. That's when we're really going to see what the characteristics of the labor market are. And, I think, the bottlenecks that we're seeing in global supply chains around goods, and frankly now at our own domestic ports, because demand is stronger than the capacity of those ports, those things are going to work themselves out. We have a flexible economy. It'll take some time, but, it took the experts managed to create a vaccine faster than certainly than I expected. And I think this stuff will work itself out over the course of next year. That is my baseline understanding, and that's very widely held among people. But, we are prepared for different eventualities, and we will use our tools to achieve price stability and maximum employment. And we're going to let the data lead us to where we need to go. Our policy will adapt, and has already adapted, to the changing understanding of inflation and of bottlenecks and the whole supply side story, which is also partly a demand story. So our policy will continue to adapt as is appropriate.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking our questions. So you announced that the Fed is going to taper at a rate of starting at $15 billion a month. And that's more than twice the pace of the last taper. So why are you tapering faster this time?
The economy is in quite a different place than when we tapered back in, I guess it was 2013. We were much farther away from maximum employment. Inflation was much lower. This is an economy where demand is very, very strong, and job openings substantially exceed the number of unemployed people. So the need for further stimulus is far less than it was in 2013, where we still had quite a ways to go. I mean, after we began that taper, it was still many years before we reached what I would characterize as conditions consistent with maximum employment, let alone price stability. So this is quite a different situation. And, the committee unanimously felt today that we had met the test that we'd articulated, and this was appropriate. And this is faster than what people had expected 6 months ago. It's earlier and faster, and that's because as I mentioned, our policy has been adapting to the situation as it evolves, as it's clarifying itself, and that's partly because we see inflation coming in higher. So.
Thank you. Let's go to Mike Derby.
Yeah, thank you for taking my question. I wonder if the Fed has given any thoughts yet to the end game for the balance sheet in terms of, once you get the taper process complete, will you hold the balance sheet steady, or will you allow it to start passively winding down? And then in a related question, do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic impact? Have you been able to, measure it or quantify it in any fashion? Because I'm sure there's often been questions about what is bond buying actually doing to help the economy.
Sure. So in terms of the balance sheet, those questions that you mentioned, we haven't gone back to them. Now that we've tapered, I expect that that's exactly what we'll do in coming meetings, and we'll do it in an orderly fashion. And we'll talk about reinvestment and all those things. And we don't have to make decisions on those yet. But typically when we're doing a new subject like that, we'll have a series of briefings and discussions, and that's what we will now begin to do. In terms of the effect of asset purchases on the economy, so there's a tremendous amount of research and scholarship on this, and you can kind of you can find different people coming out with different views, but I would say the most mainstream view would be that you're at the effective lower bound. So how do you affect longer-term rates? There are two ways. One, so you can't lower rates. Let's say you can't lower rates any further, hypothetically. So you can give forward guidance. You can say we're going to keep the rates low for a period of time, either a specific period until certain conditions are met. The markets will do the math, and that'll have an effect on longer-term borrowings, even 10, 30 years out, kind of thing. So that's one thing. The other thing you can do is you just go buy those securities, buy longer-term securities. That will drive down longer-term rates and hold them lower. And rates right across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. So that was discussed long before anybody did it. That was, I think, Milton Friedman said that was what you could do if you were pinned at the lower bound many, many years ago. So anyway, that's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies right next to each other and do a scientific experiment. But most of the findings are that it does support economic activity in the way that you would expect, which is to say, at the margin, more economic activity with lower rates, which is why we do what we do. More accommodative financial conditions lead to more economic activity over time with a lag. So I think that's the main finding I would say on QE.
Thank you.
Thank you. We're going to go to Paul LaMonica at CNN.
Chair Powell, you've addressed already questions about the stock purchases that took place from some of the regional Fed presidents, and addressing the American people to make sure that they can trust the Fed. I was wondering also, in light of the fact that we now have questions about your own future, whether or not President Biden will nominate you for a second term, what would you say to the president and to senators that potentially will be voting on a renomination about this specifically with regards to your future as Fed chair for a possible second term?
So I will answer your question, Paul, but I'm not going to have any comment whatsoever on the renomination process at all. I will say, though, that I have briefed administration officials and I've briefed people on Capitol Hill in detail about what we did and why we did it, and seeking their feedback, getting their reaction. But this is part of my job. Congress has oversight over the Fed, and we take that very seriously. So if you're on our one of the two committees that has oversight over us, then I'm in regular contact with you probably. And when something like this comes up, I'm on the phone. I'm offering to meet with you and explain it to you and answer your questions and identify any concerns people might have. That's just part of my job. So I do that. I don't talk about particular conversations, but you can assume I'll always do that, and I certainly did it in this case.
Thank you.
Thank you. Let's go to Hannah Lang at the American Banker.
Hi, I wanted to
ask about the supplementary leverage ratio. Is the Fed still planning on seeking comment on ways to permanently adjust that? And how concerned are you ultimately about banks' willingness to intermediate in the Treasury markets without a permanent fix?
So I don't have anything for you on supplemental leverage ratio right now. We are looking at ways to, if there are ways we can address liquidity issues through that channel. We also have there's a working group headed by Treasury about over Treasury markets and what happened in the acute phase of the pandemic and what structural things may need to be done. So that would be part of that work stream. And I know that there's a lot going on. I'm not sure when that report will be out, but so it's work underway. That's one of the many issues that are part of that, along with things like central clearing of treasuries, greater central clearing, and many other ideas. It's important that we have a liquid treasury market. It's a huge public benefit that we do, and I think we need to do those things that enable that, while also assuring safety and soundness of our largest financial institutions, who tend to be the main dealers. So we have to make sure that's always a first-order concern as well.
Thank you.
Thank you. Let's go to Brian Chung at Yahoo Finance.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. So just to expand on the ethics conversation, you talked about how you've engaged with people on Capitol Hill and in the administration. You talked about what you've done already, but I'm just wondering if you could take a step back and just assess whether or not there was reputational damage as a result of that, either from the public's view or from the financial community's view of the Federal Reserve's independence. And then secondly, do you look back on the whole episode and have thoughts on your individual responsibility in preventing something like this from having happened?
So I think it's too soon to say what the reputational damage is. I think from the very beginning, my reaction was we need to deal with this straightforwardly, transparently, and forcefully, and that's what we're going to do. I mean, it means everything to me that we do whatever it takes to make sure that nothing like this happens again. And I like to think we've made a real good start on that. If you think about it, you cannot execute a trade unless it's pre-cleared. And then you have to say execute. It's not even a trade. Really, there's no trading going on. This is for investment and getting liquidity for life's expenses. But you then have to wait 45 days to actually execute that sale or purchase. So I think it's a pretty good system. We'll always be looking to make it better. So in terms of our independence, Look, I think we will address this, and I think we have, and I like to think it's enough, but it's going to, we're just beginning to implement it. We have to write the rules, which we're doing, as quickly as possible. We need more people. We're going to have to resource this much more significantly here at the board. And also, we're going to need appropriate technology because, the Fed has system has more than 30,000 employees. Not all of them, far fewer of them will be covered by this. But the senior officers who will be covered by this will have to have technology access, and it's going to have to work efficiently. So there's a lot of work to do to implement it. Again, I would just say. This system has been in place for decades, and 12 different ethics officers at 12 different banks, and you had ethics people here, and compliance wasn't all exactly the same. It was a little bit different and uneven, and also the rules were we didn't imagine the problems that happened, and they may have actually been, I don't know this, but they may actually have been in compliance with the specifics of our rules. They were clearly not in compliance with the part of our rules that said don't do anything that would create a bad appearance. I mean, that's clear. This was a bad appearance. So anyway, what can we do? We are where we are. It happened, and we just have to deal with it forthrightly and transparency and own it and step up to this, meet this moment. I'm totally committed to doing that. And again, if there are better ideas, I'd love to hear them. But I think we have so far made a good start.
When you say you spoke with administration officials, did that include the president?
I'm not going to answer who I spoke to at all. I'm not going to give you any names, so don't take that as a yes or a no. I'm just not going to start down that road.
Okay, thank you. We're going to go to Jeff Cox for the last question.
Yeah, thank you. Chair, I just want to dig a little bit deeper on employment. We've seen what's been called the Great Resignation, with folks leaving their jobs in record numbers. Is there any feeling there that maybe you've been accused of fighting the last war, that perhaps the labor dynamics have changed in the post-COVID environment, and that full employment may not look like what it looked like before?
Yeah, so what's happening is people are leaving their jobs. They're quitting their jobs in all-time high numbers, but in many cases going back into employment and getting higher wages. So a lot of the higher wages you're seeing are for job switchers rather than incumbents. So that's a sign of a really strong labor market, as opposed to people just running off and quitting. There have also been there are a significant number of retirements, and we'll just have to see what that means. So toward the end of the last cycle, which was the longest in our recorded economic history, we did see labor force participation moving up well above what economists estimate was the trend. And part of that was people staying in the labor force older and just not retiring at the rates they were expected to retire. So maybe this was just catch up on that. I am a believer that over time, you won't know how far, you won't know what can happen with labor force participation in advance, and you're just going to have to give it some time, because we saw that over and over again. There are things that we can say, you know, this is where the limit is. Labor force participation is a much more flexible subject for me, and so I do think we need to be humble about what the limits are of labor force participation. But we expect labor force participation to pick up. We don't know the pace at which it will do so. So in terms of full employment, as I discussed earlier, I think at the very beginning of the recovery, the natural thing to do was to look back at labor market conditions in February of 2010 at the end of the longest expansion in our history. It was so much to like about that labor market, really historically good labor market, never perfect, but a good labor market. We're in a different world now. It's just very different. The pandemic recession was the deepest, and the recovery has been the fastest. And wages didn't really go down, and real incomes were more than fully replaced by fiscal policy. All of this is completely unusual. An economy where inflation was driven by services is now inflation where all the inflation is in goods, which have had negative inflation for a quarter century. So you ask about full employment, I think we have to, I'm very open to the thought that it's going to be an empirical question of where it is located, and we're just going to learn more and more. I mean, one thing we'll learn, I hope we'll learn in the near term, is once the Delta variant really does continue to decline, what's going to happen to employment? Are we going to start to see over the winter significant increases in jobs again? If you look back, the 3, 6, and 9-month average job creation is between 550,000 and 600,000. So if you think of that as a stronger, you don't have to think back to the million job months of June and July. You can just think, okay, 550 to 600. If we should get back on that path, then we would be making good progress. And we'd like to see that, of course. So we'll know so much more, and believe me, we understand it's a different world in so many ways, and we're very open to that.
Thank you, Mr. Chair, and thank you all for joining us today.
You.
The chairman of the Federal Reserve, in his words, I don't think we're behind the curve. Here's the price action following that news conference. This is the message from the market. Record high, record high, record high. On the S&P 500, up 0.5%. On the Nasdaq, up 0.9. On the Russell, small caps flying at 1.9%. Switch up the board and get to the bond market. 2s, 10s, and 30s look like this. Yields up at the front end just by a couple of basis points. Bear in mind that earlier in the last week, we have breached 50 basis points on a 2-year right now, 47 157. Just short of 160 on 10s, up 4 basis points on the day. On 30s, up 4 as well, just short of 2% at 199. And in foreign exchange, the dollar just a little weaker here, just a little bit softer. Your dollar index is negative, a little more than 0.1%. Tom Keene, the chairman of the Federal Reserve, stepping back from the word transitory, but clinging to the underlying theory. The leader of the Fed, quite clearly, wants to remain patient.
Fascinating, John. And one thing I want to say is he gets better and better. He's very different from the press conferences that we saw with the first of Chairman Powell. I love what Michael Darda just publishes on this, John. He was fired up today and continues further. He calls the reigning macro blather, quote, paleo-Keynesian rubbish. And the chairman today pushed against paleo-Keynesian rubbish.
He called it the dovish taper. It's pretty clear that the chairman of the Fed, Lisa, wants to sound credible about acting if he has to, without sounding impatient about moving anytime soon. Do you think he was successful? The market seems to say yes.
Operation Do No Harm, Operation Don't Budge Anything seems to have worked pretty darn well. And if you take a look at equities at near or at record highs, I guess that people who want him to just perpetuate the risk on feel will be happy. The issue is he wants patience. And I do think that the conversation going forward will be how much patience can he afford to have when the balance of risks is getting more and more weighted toward the potential overshoot and what that means.
He did something very early on in this news conference that a lot of people picked up on that I thought was really interesting as well. And shout out to a Fed watcher that I have a ton of respect for, Tim Dewey. He pointed it out as well. He offered us a little bit of a timeline here. Take a listen to what he had to say at the very beginning of this news conference.
Supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Certainly we should see inflation moving down by the second or third quarter. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately.
It's all about the timeline now. The reaction function. There's a deep understanding of that, Tom. And the second and third quarter. Look, whatever you think about the T word, the chairman of the Fed has just told you now, the second and third quarter is a key test for this Federal Reserve, Tom. That's the timeline. That's the timeline he mentioned at the start of this news conference.
He reestablished the timeline today, John. I thought it was very, very nuanced. I thought, frankly, there were some important questions there. And also important, the prepared comments he made when he looks down. For those of you on radio, there's two answers. One is where he's talking, like near the end, and the other's prepared comments that message their message, John, as they go to the data, including Friday's jobs report.
Lisa, that wasn't lost on you either. That first question, he started flipping through the pages pretty quickly to find the answer to that one.
He was going to read that verbatim. And interesting that it had very similar tone to ECB President Christine Lagarde, basically saying, I'm not going to necessarily say the market's wrong. That's not what we're seeing, but we will adjust as it seems fit. What I thought was interesting, that was pretty soft pushback. The markets didn't really respond. To me, that says everything. Those who believe that inflation is hotter than expected continue to believe that. Those who buy the Fed continue to buy that.
Did you like what happened when Mike McKee finally got a question? Tom Keene,
Well, let's stop here, John.
Maybe.
There's really important questions asked. You and I have talked often about the difference between an ECB presser and a Fed presser. And then there's the McKee question.
The McKee question. Michael McKee
every time
joins us now. Mike McKee, I have to say, if President Lagarde and Governor Bailey are watching this, they're probably happy that you're not in those news conferences. Can you walk me through what you learned, sir, in the last hour?
Well, I think what we learned is that the Fed is getting a little bit more humble about its forecasting abilities. They did not put a timeline on when they thought inflation would go down, other than in broad strokes 2022 previously. Now they're saying second or third quarter, but they had left the impression in the markets back in the summertime that we were going to see inflation come down rather quickly, that transitory was an actual thing. Now they're saying it's expected to be transitory, and the chairman raises the possibility we could go into the third quarter with inflation elevated. The other interesting thing here is that they said they're going to start tapering $15 billion a month in November and in December. but they did not put any numbers on January going forward from there. They said it appears likely that we would do that in the same numbers, but they've left themselves an out now. If inflation doesn't start to move down a little bit, doesn't start to ease off some, then they can easily speed up the taper, and if the economy doesn't recover from its third quarter swoon, they could easily slow it down.
Mike, we're among friends and family. Why did Chairman Powell pause over your question? What forced him to stumble there? Seriously.
Well, I suspect the Fed is concerned about the perception that they could be behind the curve, because then the market starts to take its own actions because they don't want to wait for the Fed. And so he wanted to make it clear that the Fed is aware of the possibility that they could be wrong. And he went on at great length in his answer to me and other people about how this economy has changed. It presents unique forecasting difficulties. And they are, as I said earlier, humble about whether they can be accurate or not, but they're doing their best.
Michael McKee, thank you so much, and please stay with us as well. Right now, we're going to finish incredibly strong. I believe Michael Ferroli to join us here in a bit. Right now, Jeffrey Rosenberg with BlackRock, portfolio manager of the Systematic Multi-Strategy Fund. And what I love about him is the mathiness of his Carnegie Mellon. Does the Fed know the math? Do they know the reaction function, Jeff Rosenberg?
Well, I think it's the other part of your question, Tom, is does the market know the Fed's reaction function? And I think we got, a little bit of that today, another reiteration, and a pretty successful one, as you were talking about a few minutes ago, of kind of taking out the hawkish fear. This is a bond market that has seen globally some pretty dramatic changes in central bank policies. You look at what happened in the RBA, you look at Governor Bailey and the BOE and the BOC, some pretty dramatic reactions to inflation. And that had spilled over into market expectations for the Fed. And I think at least for a moment today, the Fed had, along with the ECB, have tried to, kind of hold the ground there. But you have a very different global backdrop here where you have some central banks, historically more wedded only to the inflation mandate, really reacting to this inflation and its possibility of not being transitory. And here you have the Fed and the ECB kind of holding firm. That's going to be the tension I think we see for a while. Maybe it'll show back up in the markets on Friday, because labor markets and labor market healing are going to be the key kind of determinant of that timing of liftoff. And I think that's where the topic is clearly going to be the focus.
Jeff, as you know, disagreeing with the Federal Reserve is a sport on Wall Street. There are a couple of ways of disagreeing with the Federal Reserve, though. You can question their reaction function or question their forecasts. The former is a lot higher bar, I think, than the latter. So let's talk about the latter. They have basically told you now how important the second and third quarter is. Now, we can have a conversation about their forecast. They believe that through second quarter, through third quarter of next year, inflation declines, and perhaps markedly. Do you take the other side of that and validate where the rates market has been priced over the last month or so?
No. I mean, a lot of forecasts have inflation coming back down around that time period. So, it's not necessarily out of consensus to say that, second quarter, third quarter. Maybe what was surprising, and maybe in hindsight they may regret that because the forecasts have to change, they have to evolve. But, what we're talking about here is not necessarily, dramatic declines in inflation, but just that inflation stops going up. And particularly that broad-based measures or trimmed-based measures of inflation outside of these categories. I think the Fed, when they were talking about transitory, they were talking about these clear COVID-impacted sectors. And what they got wrong was that it did spread to broader-based measures. And it's really seeing the halt in the increase in those broader-based measures that I think the Fed and the forecasts are talking about that will take some of the froth off the boil of inflation fears. Now, of course, if that doesn't happen, then there's a forecast error. There's something structurally going on, and the Fed may have to react. Whether or not they will and to what extent still remains to be a debate. But I think the forecasting that the inflation will stop going up at this rate isn't really that much out of line with market consensus.
The chairman sounding a whole lot more humble about the future. President Lagarde coming out with some really strong pushback in the last minute or so in an interview with the broadcaster, Lisa, saying 22 is off the chart in respect to interest rates. So that's some sizable pushback from ECB President Christine Lagarde. And I just wonder if this equity market just really gets the joke right now.
Yeah.
Small caps up by 1.9%, the S&P at a record high, up 0.5%. The Fed's telling you this: demand's really strong, and inflation isn't going to encourage us to move in anytime soon and hike interest rates. That, Lisa, is a fertile environment to keep buying risk.
And this is the key question. Is the ECB in such a different position than the Federal Reserve that we cannot really draw comparisons to when they lift off and what they message? And I wonder, Jeff, from your perspective, if you think that that's what was messaged with Jay Powell today, giving basically a very similar pushback to market expectations as ECB President Christine Lagarde, and not really getting much of a reaction at all.
Yeah, and you know, for the Fed, they're in a different position with regards to the shift in flexible average inflation targeting, and that gives them more, as is in the word, more flexibility, but it's also the shift in kind of broad-based and inclusive labor markets. And that is an important shift in terms of the balancing of the dual mandate between labor market gains and inflation costs that in my assessment, you know, tilts it a little bit more towards labor markets. It's also a function of kind of public policy and public willingness to absorb the higher costs of inflation, and how those higher costs of inflation are really a distributional challenge. It doesn't affect the overall economy in an equal fashion. And that has a great impact in terms of how the policy trade-offs between employment and inflation will ultimately be decided if we get to that point of a real significant persistence in inflation.
Jeffrey Rosenberg, thank you so much with BlackRock. Right now, NASDAQ up 0.9%, some real strength of the tape. The VIX doesn't go to a 14 level, but we're watching that carefully. We are as good as our guests, and we love on this day of a long Bloomberg surveillance to finish strong with Michael Ferroli with JP Morgan. His work has been definitive. His weekly prospects Friday late is the read of the weekend, or at least the beginning read, I should say, of the weekend. Michael Ferroli, this week you were strong with Bruce Kasman. It was on wage growth, and it was also on savings. How does this Fed adapt to the diminished savings of this unique boom economy, this unique pandemic?
So I think on the wage growth thing, I think that's what's interesting here is what's really going to be operative for liftoff is clearly full employment. And what I was most interested in listening to Chair Powell today was his continued modest evolution toward a bit more, pessimism on the supply side of labor supply, which is to say, not so sure the participation rate is going to bounce all the way back to where it was in early 2020. Still, he's holding out hope that, we're going to see some pickup in participation. So the nuances there, I thought, were what I was most interested in thinking about the next stage of the normalization of Fed policy, which really just comes down to when they judge that we've actually reached full employment.
Michael, this is so important. Your view on where the participation rate is going ultimately spells out what you think about this labour market right now. Is there a ton of slack or is it tight? What's your view on that now?
So I tend to agree with the chair that we are not at full employment, that the tightness in some measures like the vacancy to unemployment ratio, that some of that is it's not necessarily going to persist if some of these people come back into the labor market because of Delta issues fading. It's interesting, the chair a number of times said, well, now that Delta issues are fading, we'll soon get a cleaner look at both the inflation picture, the employment picture, the overall economic picture. But, now we're starting to see some hints of seasonality in the virus and a little bit of a pickup in some of the northern states. I'm not so confident that we're going to get a clean picture of the economy in the next couple of months, even though the chair seems to think has a little more optimism in that regard than I do. But I guess I would say that in terms of full employment, I don't think we're quite there yet, but certainly a lot of pollution in the figures due to the virus issues.
Michael, I was going to ask you about Friday's jobs report, but before I even ask you about the details and what you're looking for to edify your view, is it really something to watch? Can you make a decision around this labor market report, or is it still too noisy based on what you're saying?
So it's been noisy for a year and a half, but you have to make judgments at a certain point. I will be very interested, and the chair mentioned this today as well, that we recently had school, the back to school happen. We recently had the end of the unemployment benefits. It may have been too early to see that in the September jobs report. But I'll be very interested to see if there are any hints of that actually having any impact in the October numbers we get on Friday. But look, you never want to take one jobs report in isolation, and I do think there still are factors that are going to muddy it, but I wouldn't say we discard it for that reason by any stretch of the imagination.
I'll let the equity team over at JP Morgan do the stock stuff, Michael, but I do want to ask you a question related to it. This is a NASDAQ right now up for an 8th straight session. It's an S&P 500 at an all-time high. And for the reasons I described a few minutes ago, there's a reason to believe this is very bullish for risk assets. The idea being that demand will remain hot, that inflation won't be robust enough, broad enough for the Fed to come in too early. I wonder from your perspective whether higher prices starts to hurt demand increasingly, materially going into next year. Do you see that evolving in some way? Do you see evidence of it now, Michael?
Well, certainly we saw evidence of it in the third quarter, right? Nominal demand was pretty decent, but once you took account of price increases, the real increase in output and demand was pretty paltry. So we're already seeing that. I would suspect as we get into next year that starts to fade. I think yesterday we saw some, maybe the faintest of green shoots in the auto data, which showed a little bit of a pickup in sales, a little bit of a pickup in inventories. If that can continue for the next couple of months, again, echoing the chair today, the auto industry has been so important to both the price and the activity data that things like that, if that picks up, I do think. Go ahead.
I got to rip up the script here, Michael, because this is really important and goes to your weekly prospects. Do we, or the chair, do we have a true understanding of the American economy when you look at auto manufacturing issues, supply issues, inventory surprises, and odd net exports? Do we really know where we are?
Well, we never know perfectly, and I think the chair showed a good amount of humility, which was appropriate. And I think, look, the past year and a half have been exceptionally difficult. But I do think we're getting a little bit of a better picture here of where we are. Certainly better than we had been a year ago. But I mean, Tom, this is an imperfect science, and particularly when we're trying to do it in real time with data that gets revised. And so, nonetheless, that's what we're operating with. I do think things are certainly improving in terms of activity data as we head into the fourth quarter. The inflation's more in question.
Michael, love catching up with you. You know that. Thanks for being with us. Michael Ferroli there, Chief Economist at JP Morgan. Tom Keene, all-time highs in this equity market off the back of this. Bottom line, record high, record high, record high.
And John, let's dovetail this to get to tomorrow morning where we will have Bloomberg surveillance onto the jobs day as well. I'm sorry, John, equities melt up. VIX just hit 14.99. And as a general statement, John, bonds do nothing.
Did you almost call me Bond there, Tom?
Yeah. I did call you
almost
Bonds.
happened.
No, it's because you look like Daniel Craig.
John,
It was like Daniel Craig.
Okay, slow down. Lisa, let's not lose this moment. This Federal Reserve chair started this year with a T word and has pushed it all the way out to the third quarter of 2022.
The issue that I think is the most compelling from this whole moment is that he said we need to have patience because the labor market is just that confusing right now. The problem is, again, it goes to this core issue. Where are the balance of risks? Is it potentially more damaging to the economy to allow an inflation overshoot and then respond to it? Or is it more damaging to curtail an economic recovery too early? That is the debate going forward.
And lessons about humility, Lisa. Tom, reflect on that going into tomorrow, about being humble.
Oh, boy.
Humble. Looking forward to the coverage through the market close a little bit later. Let's bring in Romain for more. What's coming up, Romain?
All right, we are counting you down to the close. Record highs across the board on the indices. A lot of individual record highs as well. AMD, Microsoft, just to name a few. PepsiCo as well. A lot of the consumers' discretionary names. That's your leader on the day. In fact, this has been your leader here for the past month. Tom, you mentioned a melt up here. Ed Yardeni, of course, had a great note out prior to the Fed announcement, talked about this melt up. He said, look, this latest leg of the bull market has been much more about earnings and a lot less about Fed support. Ed Yardeni going to be joining the program a little bit later. Kathy Bastanic also going to be joining as well.
You're selling it nice, Romain. Sell me the melt up in small cap that I observed.
The melt up here is 93% earnings beat when it comes to bank stocks, 90% beat when it comes to technology stocks, 80+% beats when it pretty much comes to everything else here. Basically, if you're in anything other than real estate utilities, you're getting game here, and you're getting it from earnings, not the Fed.
Romain, thank you. Yeah. Looking forward to the programme through the close. Tom Keene, all-time highs to wrap things up for us. Are you going to be with us tomorrow morning?
Yeah, I'm looking for an entry point. I got to go readjust, reset the triple leverage.
Couple of beverages a little bit later.
Just a couple.
Just to add to the couple that we had before the show.
36,000. There ought to be a book about that.
I think there was a book, Tom. I think there was a book. From New York City this morning. Good morning.
Good morning.
Did you like that? That was for you guys. That was for you. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology, pixels, and binary code with a human and humanizing content.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Ray.
And I'm Romain Boston.
Let's check in on what's happening in terms of the outperformance of small caps today. We see, of course, well, the Fed do exactly what many had anticipated in terms of tapering, but maybe a slightly more dovish tilt in terms of as and when we'll see rate hikes. Cyclicals outperform the small caps, up on, continuous step change on the day. But even big tech got a play remain, and that's something you've been talking about throughout the afternoon.
Yeah, much more than big tech. Pretty much everything in the discretionary sector. We're going to have Ed Yardeni on What'd You Miss a little bit later here. He had a great note out prior to the Fed meeting where he talked a lot about this melt up here and basically saying that the rally that we've seen in this bull market, it was less about Fed support and much more about earnings. Those earnings have definitely been on fire pretty much. And you see the last two lines of your screen there. These are pretty much your leaders. Tech stocks here, as reflected in the Philadelphia Semiconductor Index, record high on that index. S&P consumer discretionary names, that's also at a record high here on the day. Pretty strong. What you're not seeing, interesting though, are some of the industrial names, are some of those cyclical names, are some of those energy names. In fact, at one point on the day, we had the WTI actually tick below 80 bucks. They didn't mention that during the Fed special. We're going to mention it here, folks, because this is significant and it gives you a sense into where investors' mindsets are at. Because it's less about what Jay Powell just said and much more about what the companies, corporations have said. 40 companies reporting after the bell. We're going to bring them all to you, hopefully.
Well, let's do it first right now with Jason Katz, Managing Director and Private Wealth Advisor for UBS, where he oversees about $3 billion in assets. To talk about these equity markets that continue to be on fire, sort of navigating nicely the comments that we just heard from Mr. Jay Powell.
Yeah, look, Powell and company absolutely threaded the needle today. And there was a lot of tension, particularly in the bond market heading up to this meeting. And we've seen a sigh of relief there. So the focus, as Romain said, has shifted from COVID to earnings and, frankly, to monetary policy, which will be the main market drivers, at least in the near term.
What about, the impact of oil, the impact of energy, the fact that we have seen such an acceleration in some of these inflationary pushes, but we look through, of course, that inflation, it's still transitory, according to the Federal Reserve, but oil falls some 4% on the day, Jason.
We've had this perfect storm in terms of energy inflation, and you add to that all the other factors that are causing traditional inflation. With respect to energy inflation, between bad weather, hoarding of supplies, a disproportionate amount of investments going to sustainable is getting a lot of companies and governments, for that matter, to rethink where their spend is on a going forward basis. And with respect to traditional inflation, I hate to use the T word because it's arguably the most used word in our vernacular today. I think Powell is erring on the side of letting inflation run its course because in the latter part of this year, I do think a lot of the supply chain issues start to abate as antivirals kick in, as vaccination rates go up, as moms get back to work when their kids get back to school.
What do you think, Jason, about some of the comments that Powell made on what you were just talking about there and this idea that the Fed is kind of looking at Q2 and Q3 of next year as being sort of critical for a much more better assessment of where those inflationary pressures stand, and the idea that if they have abated by then maybe some of the bets on rate hikes may not necessarily be accurate?
That's right. I mean, I was surprised pleasantly that they actually put a timeline on it. I didn't think that we'd hear that. But we have the tale of two tapers. It's not just the Fed in terms of well telegraphing these asset purchases, but the Treasury is going to curtail issuance as well. And I think that he recognizes that supply chain bottlenecks, while you're in them, feel like you're never going to get out of that vortex. But between trade tensions easing and starting to see a little bit of abatement in terms of supply issues, I think that we could withstand a little bit more persistent inflation through the latter part of next year.
Jason, you talk a lot about the supply and demand dynamics within the bond market. That Treasury piece, of course, coming out this morning. How does that set us up then for a lot of the commentary this week that the moves in bond yields were technical to shifting now towards fundamental?
Yeah, I mean, the flattening of the yield curve really was a head scratcher. You have the bond market sending one message and the equity investors sending another. And we're starting to see that unwind a little bit. There was a lot of short covering that is occurring there. And we do anticipate the yield curve to steeping. And I think that you're going to see a 2% 10-year over the course of the next 12 to 18 months, but for all the right reasons. And that's an economy that's directionally moving the right way.
Okay, directionally moving the right way in terms of the labor supply as well. It's interesting that we've, of course, been talking a lot about supply-demand dynamics when it comes to the inflationary pressure, particularly supply chain issues. But the supply chain of labor and inflationary pressures there, do you worry about that at all, Jason?
I certainly do. I mean, we've seen such an incredible shift in terms of people retiring earlier or pivoting in terms of what they want to do with their career, the ability to work from home like I am right now and being equally, if not more, productive. I do think now that unemployment benefits have rolled off, kids are getting back to school. Not a lot of those numbers haven't been factored into the numbers of late, the employment numbers. And I think you're going to see a lot of these 5 million jobs that we had prior to COVID start to come back in the coming months.
All right, let's talk about, I guess, market sentiment then going forward here, Jason. Only a couple minutes left here. As we get sort of the actual taper itself, and as we move into next year, and hopefully we get a little bit more clarity on the economy, do you think that the investor sentiment that we see right now, the appetite for risk assets, that will remain at least in some sort of measurable level to what we have now?
I mean, look, there's very few choices. I run money for individual investors, and it's a head scratcher for a lot of them between debt ceiling, worries and concern about tax policy and supply chain issues. And yet here we are making new highs. And you said in the beginning of this segment, it's all about earnings. We're going to look at 35% year over year earnings this quarter. And with the tax hikes likely not to be as onerous as we originally thought, we could see north of 10% earnings growth next year. So the multiple of the market, interestingly, is lower today than it was on Jan 1, in spite of the S&P being higher. And next year, I think we're going to get more muted returns, albeit positive. So, I'd expect a twitchy market over the course of the next 12 to 18 months, but 5,000 for the S&P is certainly within reach if we can get 10% earnings growth and a Fed that largely remains accommodative. We're not going to see a rate hike for at least 6 or 7 months.
Jason Katz, Managing Director and Private Wealth Advisor for UBS, working from home. It's great to have some time with you, sir. He talks, of course, about earnings, and we got them coming thick and fast in just a few minutes. We've got the likes of Qualcomm, Booking, Roku, Etsy, you name it, we're going to be covering it. And we're at a record high also finally in the Russell 2000 as well.
And on the Russell 2000, seeing some of those small cap names, Tesla, a big barometer for risk appetite, that's trading right now at a record high. Meanwhile, you got the VIX at one point was actually below 15.
Still trying to hold on to a 15 handle here, Romaine. Certainly interesting as we count down to the closing bell.
All right, well, let's do that right now, as we always do around this time, as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Caroline Hyde and Taylor Riggs, counting you down to the closing bell, here to help take us beyond that bell. Our global simulcast partners, Carol Massar and Tim Stenovic, bringing together all of our television, radio, and YouTube audiences worldwide to parse the crucial moments of the trading day. And of course, the crucial moments of that day pretty much happened between 2 p.m. and about 3:30 p.m. East Coast time here. The market pretty much got what they wanted to hear, Carol, and it appears that this is a green light right now for risk assets.
Yeah, everything is awesome, it feels like. We definitely see stocks just coming off their highs of the session, right? What's interesting for me, those major equity averages, as you just said, Romaine, really just some outperformance there. Speaking of outperformance, the Russell, I've been watching those small caps up 2.2% at their highs today, up about 1.8% as we tick closer to the close. They're up almost 7% in the past 5 trading days. So if you're looking for some outperformance when it comes to the market, Tim, check out those small caps.
Yeah, a big takeaway for me was just that the Fed did a really good job communicating. If you see what happened in the bond market and happened in the equity market today. At the same time, I do want to draw your attention to what happened with Bitcoin right at 2 p.m., falling 3.5% before moving higher by nearly 5% from that low. So a really interesting move happening in crypto then.
Yeah, the whiplash that we see as they worry as to whether we'll have liquidity or whether it's a more dovish tone in the longer term coming from Powell. And the dollar also reaching a session low as well. Across the asset move, what's notable, Taylor, has also been the energy move as well.
Yeah, Romaine has been highlighting that as well. Caroline, I wanted to touch on that dovish tone that you mentioned. A very calm and stable 2-year yield at a 45 basis points. A lift up higher. We're now above 2% on the 20s and the 30s, Romaine, as perhaps we are learning we are going to be dealing with a little bit of the higher inflation in the long term, why we continue to focus on the labor market.
All right, getting the closing bells, 36,156 on the Dow Jones Industrial Average, up about 100 points or 0.3%. The S&P 500 also at a record high, up about 30 points here. That's led by discretionary materials and consumer staples. Sitting out of that rally, energy, utilities, and industrials. The NASDAQ Composite up a respectable 1% here, 161 points here. We should point out just real quickly here that Tesla really led the charge there. That's closing at a record high right around 1213. And the Russell 2000, you pointed it out, this is the relative outperformer here. The Russell 2000 up about 1.8%. This is led actually, though, largely by a lot of those discretionary names as well as healthcare. Remember, energy, utilities still kind of sitting this one out.
Meanwhile, we get the earnings thick and fast, and of course, a company that is in the line of sight when we think about supply chain issues is still continuing to do incredibly well. Qualcomm, of course, biggest maker of chips that go in your smartphones, fourth quarter adjusted revenue, $9.32 billion. The estimate was for $8.86. It's a beat, and they forecast a beat as well. First quarter revenue to $10 billion to $10.8 billion. The market had been seeing 9.73, so well ahead of expectations, and their earnings per share, a big beat as well. This is a company that is thriving in this ability to raise up prices and continue to see demand for such electronic goods at the moment. No, at the moment, worries about, of course, that Apple supply chain issue, a big supplier there.
And not earnings, but certainly some big news here. Blackstone looking to start a structured finance unit in about a $50 billion push. It's going to be this direct lending program overseen by Jonathan Pollock. Of course, all we are hearing here is they are aiming for gross originations, about $50 billion again in direct lending in 2022 would be about a 20% increase from this year's volume. Continuing to look at the real estate's, of course, debt strategies that he had overseen previously.
All right, let's also bring in Booking because we're seeing the stock actually not moving much in the after hours. But again, this really plays into the economy reopening. Are people getting back to traveling? Booking third quarter revenue, it's a beat, folks, $4.68 billion. The estimate was for $4.3 billion. Third quarter adjusted EPS, $37.70. And that, too, is a pretty significant beat. Estimate was for $32.23 a share. And gross bookings, this was key. This is what the analysts wanted to see. $23.7 billion. The estimate was for $21.63 billion. So again, it looks like some outperformance and beating certainly some of what the street was expecting, Romaine.
We want to get back to Qualcomm in a second, but real quickly, Electronic Arts is reporting they did beat on adjusted revenue for their fiscal second quarter, $1.85 billion. The street was looking for $1.76, $1.58. That's your adjusted EPS numbers because everything's adjusted these days. The estimate was $1.17, and their guidance looking pretty strong here. I'll give you the full year only. Full year EPS $6.95. Street was looking for $6.63. Full year adjusted revenue $7.63 billion. The street was looking for about 7.5.
Meanwhile, let's go back to Qualcomm because it's interesting that we are digging into the press release where it's all about the Internet of Things, of course. In addition to leading the 5G transition, they say they're on pace to deliver that all-important $10 billion of annual revenue across, well, what has been IoT, automotives. Our business, they say, is continuing to diversify. This coming from Cristiano Amon. He's the CEO. Overall, it's all about managing to passing on some of those cost increases, managing some of those supply chain issues that we've seen particularly affect the automotive part of those companies. And it looks as though they're still continuing to see a strong outperformance in terms of their earnings.
Yeah, and they say directly in the release here that basically they have not seen a significant impact here on their manufacturing facilities or their supply chain due to the pandemic, and that the ability of their suppliers to deliver their commitments to us or their ability to ship products to our customers.
I'm also keeping an eye on shares of Roku right now. Shares moving lower in after hours trading after third quarter net revenue comes in just slightly below estimate, $680 million, just less than $681.1 million that investors wanted to see. Shares now down about 7%, but bouncing in after hours trading. I'm going to keep an eye on any commentary about supply chain issues. The company gets about 30% of its revenue, at least last year, from the actual platform players. But there could be some concerns about supply chain disruptions there. Not many worries about advertising disruptions, and in fact, it could actually be a boon to their business. Bloomberg Intelligence says it could be the fastest growing segment, connected TVs, that is. So keep an eye on that part of the business.
That's a pretty big drop, biggest decliner right now in the post market.
Just going to say, keep an eye on that drop, down 6.3% for your radio listeners, because that stock is definitely some disappointment from investors. Not so disappointing is what we're getting from Booking, because we're seeing that stock now up almost 5% in the after hours. Company's CEO in the press release saying we're pleased to report another quarter of sequential improvement in room night trends, which was primarily driven by better results in Europe. Revenue in our seasonally strongest third quarter, $4.7 billion, which was more than double the amount of revenue we recognized in the second quarter of 2021. So they basically say that we're seeing some signs of recovery in many parts of the world in the third quarter. This is what we care about, Taylor, right? What we want to hear about the outlook and what's going on.
And all of these, I think we'd be remiss to continue the horse race without pausing and understanding the day that this comes on from a chairman of the Federal Reserve highlighting some of the issues within the supply chain, which, Caroline, looks like Qualcomm is really doing a good job of managing. You're getting booking holdings, trying to show an increase here in some of the demand that they see. And a lot of questions on that call about how bond purchases affect the demand, Romaine, that frankly is already well underway.
All right, going fast and furious here with the earnings. Take-Two earnings are out here. Their quarterly number is a beat, 163 versus 140 for adjusted EPS here. I'm going to get right to their guidance here. Their guidance for the full year is pretty much in line with estimates, 3.3 to 3.4 billion revenue.
Now we take us to the President of the United States, who has
Today's
some
a great day
comments
for
on
American
the
parents,
vaccine.
American families, and American children. We've taken a giant step forward to further accelerate our path out of this pandemic. After months of rigorous and independent scientific review, the Food and Drug Administration, the FDA, authorized, and the Center for Disease Control and Prevention, the CDC, recommended the COVID-19 vaccine for children ages 5 through 11. For parents all over this country, this is a day of relief and celebration. After almost 18 months of anxious worrying every time your child had a sniffle or started to cough, well, you can now protect them from this horrible virus, because that would always worry you that was coming along. 28 million more young Americans are now eligible for the protection of a vaccine. And my administration is ready. We're ready from day one, today, organized and have a plan for this vaccination's launch. As soon as next week, we'll have enough vaccine and enough places, and parents will be able to schedule appointments to get their kids their first shot. And we've already secured enough vaccine supply for every single child in America ages 5 through 11. And weeks ago, we asked states and pharmacies to put together their detailed plan to start placing their orders for these specially formulated vaccines for young children. We started packing and shipping these orders last week as soon as the FDA authorized the vaccine. We've already sent millions of doses, millions of doses, and millions more to come by next week. These doses will be available at approximately, I beg your pardon, I swallowed wrong. Will be available at approximately 20,000 locations around the country. These include places that parents know and trust, their local pharmacies, their pediatricians, family doctors, and children's hospitals. Many of the vaccine sites will offer times on nights and weekends.
We are listening to President Biden. They're making some comments on vaccines for a wider group of our population. So we'll continue to monitor. Check out LiveGo on the Bloomberg if you want to continue listening to the president's comments. In the meantime, we're going to wrap it up for Beyond the Bell, our cross-platform coverage on radio, TV, and on YouTube. Lots of earnings. We're seeing reaction in the after hours. Catch us again, same time, same place tomorrow.
Meanwhile, of course, we're going to be digging deeper into those earnings. Etsy, Qualcomm, we're going to be digging into our talented team of analysts at Bloomberg Intelligence to get you the first take. Significant moves, particularly in Qualcomm after hours. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies?
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
We've had a lot more earnings cross this time, of course, coming from Etsy. Take a look at third quarter revenue, $532.4 million, outperforming estimates of $519, though not managing the bottom line. Third quarter EPS of 62 cents versus 70 cents on a year-over-year basis. Really, it is the forward guidance that pushes the shares lower, with fourth quarter revenue coming in light, $660 to $690 million. Estimates had been above that $690 million market. And then, of course, the fourth quarter adjusted EBITDA margin coming in a little bit lighter at 26%. And the CEO on this call saying the adjusted EBITDA margin of about 33% in the third quarter is something that he is talking about when he talks about continued consumer demand and increased purchase frequency on the Etsy marketplace. Let's do it all with Poonam Goyal, senior retail analyst here for Bloomberg Intelligence. Poonam, is it a fourth quarter guidance that looks light to you?
Yes, it absolutely is. On the revenues, as you mentioned, it's a little light of consensus. And on the core Etsy platform, they're looking for high single-digit growth in GMS. So slowing growth, but that's not so unexpected, right, given last year's tougher comparisons. I think if you think about the compounded growth that Etsy has had, they're still doing very well, and it seems the supply chain issues aren't that big of an issue based on the remarks that we've read so far.
Yeah, they're saying they dramatically outperform the e-commerce industry benchmarks, and now in 2021 we're lapping that performance with flying colours. They sound very optimistic on their press release. Is this a company that's going to benefit from supply chain issues? Are we going to go there for our alternative gift giving if we can't get it from the major retailers coming into the holiday season?
Yeah, I think, look, Etsy has a lot of sellers that sell into its marketplace, and they're usually mom and pops or small businesses, owners, that are crafting the goods themselves oftentimes, so they're not at the mercy of getting merchandise in from the ports necessarily. So that is an advantage that they have, and that could pull in buyers as they look for those holiday gifts that they probably can't find somewhere else.
What about the overall strategy here? I mean, we saw a couple of acquisitions earlier this year to kind of expand beyond just, I guess, the general perception or ethos of just being about handmade goods here, reselling other products here. Is there any sort of change or acceleration of that strategy?
Yeah, I mean, they just, started to integrate Depop and Elo7, and we'll see what happens. But both industries very promising. The resale industry is growing 7 times faster than traditional apparel. So we think overall good acquisitions and good strategies that can help them move past just those, gift giving or custom handmade items.
Poonam, how are you thinking about the health of the consumer in the advertising market? It was interesting that some of the bigger advertisers were mentioning that supply chains were impacting them. That might not actually be the case with Etsy, right? Can they benefit from what might be considered others' losses?
Absolutely. I do think they can, and that comes back to that their sellers are individuals largely that handcraft much of the things that they sell, which means that they don't have things sitting on a ship at a port waiting to come in. So they could take advantage of that.
Yeah, Mr. Silverman saying that he anticipates Etsy's highly distributed supply chain. Well,
they make a lot of good comments about some of the initiatives they're taking here, including the introduction of male-targeted ad campaigns in the United States. They're trying to bring in the men.
trying to lure you
Finally,
in.
hey, Romain.
I know.
Have you been
I know.
feeling
Men have
left
been
out?
just so, they get nothing, right?
We thank our female Poonam Goyal, who's on there to bring us all the latest analysis and some great deep dive on the world of Etsy. Let's get out to the First Word News now. Mark Crumpton.
Caroline, thank you very much. House Speaker Nancy Pelosi wants to add paid leave back into President Biden's $1.75 trillion economic agenda. Let's go now to President Biden. The president is at the White House. He will be discussing coronavirus vaccines. President Biden at the White House on Bloomberg Television.
And remember that we all have an obligation to accept the legitimacy of these elections. I was talking to Terry to congratulate him today. He got 600,000 more votes than any Democrat ever has gotten. We brought out every Democrat about there was, more votes than ever has been cast for a Democratic incumbent. I'm not incumbent, a Democrat running for governor. And no governor in Virginia has ever won when he's of the same or he or she's the same party as the sitting president. What I do know is, that people want us to get things done. They want us to get things done. And that's why I'm continuing to push very hard for the Democratic Party to move along and pass my infrastructure bill and my Build Back Better bill. I think if we think about what we're talking about here. People are upset and uncertain about a lot of things, from COVID to school to jobs to a whole range of things, and the cost of a gallon of gasoline. And so if I'm able to sign into law, my Build Back Better initiative, I'm in a position where you're going to see a lot of those things ameliorated quickly and swiftly. So that has to be done.
Mr. President, given what you said, do you take some responsibility, and do you think that Terry McAuliffe would have won if your agenda had passed before Election Day?
Well, I think we should have passed before Election Day, but I'm not sure that I would be able to have changed the number of very conservative folks who turned out in the red districts who were Trump voters, but maybe.
You won the state by 10 points, Mr. President.
No, I know we did, but I was running against Donald Trump.
Thank you, Mr. President. What should Democrats possibly do differently to avoid similar losses in November, especially as Republicans are now successfully running on culture war issues and false claims about critical race theory?
Well, I think we should produce for the American people. Look, one of the things that is important to understand, if they pass my legislation, we're going to be able to reduce the price. People are going to see a reduction in the price of the drugs they have to get, because Medicare will be able to negotiate and lower the price of drugs. If they pass my legislation, you're going to see that nobody, and some of you who have children in daycare or children in child care, you're paying up to $14,000 a year if you live here. You will never have to pay that much money if you live in Washington or wherever you live, no more than 7% of your income. They're going to see that, they'll get tax breaks, genuine tax breaks. If that's Trump, to tell him I'm busy. Bad joke. But anyway, but the point is that, we have to move and make it clear that what we've done is increasing their look. People need a little breathing room. They're overwhelmed. And what happened was, I think we have to just produce results for them to change their standard of living and give them a little more breathing room.
My question is, what's your message, though, for Democratic voters, especially black voters, who see Republicans running on race, education, lying about critical race theory, and they're worried that Democrats don't have an effective way to push back on that?
Well, I think that the whole answer is just to speak the truth, lay out where we are. Look, I'm convinced that if you look at everything from my view on the criminal justice system to my view on equal opportunity to my view on economic issues and all the things I have and what I've been pushing in legislation, each of the elements are overwhelmingly popular. We have to speak to them, though. We have to speak to them and explain them. Look, I just think people are at a point, and it's understandable, where there's a whole lot of confusion. Everything from, are you going to ever get COVID under control, to, are my kids going to be in school? Are they going to be able to stay in school? To whether or not I'm going to get a tax break that allows me to be able to pay for the needs of my kids and my family. And they're all things that I'm running on, that we'll run on, and I think we'll do fine.
Mr. President.
This ought to be good.
I think so too. About the way forward, Mr. President, as you were leaving for your overseas trip, there were reports that were surfacing that your administration is planning to pay illegal immigrants who are separated from their families at the border up to $450,000 each, possibly $1 million per family. Do you think that that might incentivize more people to come over illegally?
If you guys keep sending that garbage out, yeah, but it's not true.
So this is a garbage report?
Yeah.
Okay. So
$450,000 per person. Is that what you're saying?
That was separated from a family member at the border under the last administration.
That's not going to happen.
Okay, and then just a follow-up, because you mentioned Trump a couple times. When you went to try to help Terry McAuliffe a couple weeks ago before you left, you mentioned Trump 24 times. Do you still think that voters really want to hear you talking about Trump more than the issues affecting them every day?
Well, the reason I mentioned Trump, if I didn't count the times, is because the issues he supports are affecting their lives every day, and there are negative impacts on their lives. Thank you all very much.
Before the midterm election, sir, is the Democratic Party too woke?
Democrats on getting that bill passed.
President Biden exiting there, having given an update. Oh, almost. Teasing us. A vaccine update, of course, on children being able to start receiving the vaccine from the ages of 5 to 11, and then responding to some questioning regarding, of course, the outcome of the elections, particularly in Virginia. Romaine, there's some breaking news when it comes to tax changes, it would seem.
Yeah, this is the SALT, of course, the state and local tax deduction. Of course, it's been talked about a lot here. Basically allows you to deduct a lot of property taxes, local property taxes, out of your federal income tax bill. That's been capped at $10,000 since 2017. The Democrats in the House of Representatives are now proposing to raise that cap to $72,500. Of course, this is a proposal in the House of Representatives by the Democrats, so it's got a long way to go before it sees the light of day. What has seen the light of day are dozens of earnings out here. Let's get back to some of them. Qualcomm, of course, the latest world's largest chip maker for smartphones, actually gave a stronger than expected outlook for the current quarter. Joining us right now, Mandeep Singh of Bloomberg Intelligence, who covers Qualcomm for us. Mandeep, what was the first thing that jumped out at you about this report?
The fact that they managed the supply constraints much better, and the non-Apple mobile shipments, and how it played into Qualcomm's strength in the quarter. I mean, clearly it's a function of solid demand for 5G, and what we are seeing is Qualcomm benefiting from that Huawei ban a couple of years back. So they have really done well in that China market for the non-Apple or Android phones, and I think that is playing into the strength.
5G, Internet of Things, automotive as well. They're talking about trying to bring diversification. How have they managed to man the supply chain with such dexterity, given that, they're supplying autos and autos have been feeling the pain the most?
Yes, so autos is the least of their exposures. Where they have done particularly well is the mobile side, as well as the RF, the 5G rollouts, and industrial IoT is also a driver. Autos is where they have the lowest exposure. My sense is they also are facing the supply constraints, but I just think they have diversified their foundry exposure much better than some of the other players in the industry.
We only have 45 seconds. Are people double ordering chips so that we're just pulling forward demand?
There is definitely a chance that companies are ordering more chips simply because this thing can easily extend into 2023. All the executive commentary points to supply constraints being there at least for the foreseeable future. So there is that likelihood that double ordering is playing into this trend.
Mandeep Singh, Senior Technology Analyst here for Bloomberg Intelligence. Really appreciate you running over and giving us some of that analysis. And you guys, speaking of supply chains, Levi's CFO, Harmit Singh, recently provided insight into the retailer's global sourcing. It spans across 24 countries. He sat down with Bloomberg's Emily Chang as part of a new monthly program, Chief Future Officer, which profiles these leaders and explores the impact they're making on those companies. Take a listen.
If you think of supply chain, think of two broad buckets. One is sourcing and second is commodity and costing. On the sourcing side, very early on, we said we won't put all eggs in one basket. And so we source across 24 countries. And not from any single country do we source more than 20%. You talked about costs. Given our global buying power, we've already negotiated the first half of the year at a very low single-digit inflation relative to last year. The one thing, because the brand's so hot, has been really resonating with the consumers. We've continued to take pricing, even during the pandemic. The brand today has pricing power.
Levi's 2021 full-year revenues are on track to match 2019, fulfilling the company's pledge to emerge stronger from the COVID crisis.
We committed in the middle of the pandemic that when our revenues got back to pre-pandemic levels, our margins would be up more than 2 points, and we've now delivered on that.
But with the virus still weighing on consumer confidence and supply chains and inflation surging around the globe, this is no time for any retailer to relax.
As you look forward over here, I think the biggest question is who's going to take the learnings from the pandemic versus who's just going to fade back to what they did in the past.
I think over time, because of the learnings people have had during the pandemic, there is going to be thinking about how do you globalize your supply chain? Do you concentrate in a few countries? Do you diversify? Do you bring some production home? One of the programs we started a couple of years ago was our FLX program. It's using lasers to finish your denim product. It used to be done by hand. It used to be done overseas. But now we bring in the blanks and we finish it closer to markets. And so we're in the process of expanding that program around the world. So I think people need to just think about different ways of doing it. And I believe technology will play a key role.
That was Levi's CFO speaking to Emily Chang. And be sure to catch the premiere of Chief Future Officer. It airs tonight, 9:30 p.m. Eastern. All as we close out, you guys, our closing bell show and push forward to what you missed. Get back to the news of the day, Romain, where we tie in comments from the Federal Reserve within reflationary relift up to 4,800 on the S&P.
Well, it was right there in the statement. They talked about supply chains. Jay Powell, of course, talked about it in his briefing. He said it could abate. He's looking at Q2. He's looking at Q3 for a better assessment of what that is. But all told, what the market got today was what they expected. A tapering announcement set to start in November. And rate hikes, well, that's decoupled from this.
Yeah, a more dovish tone than perhaps many were anticipating.
Yeah.
Interesting reaction that you got in the dollar. It's weaker. Bitcoin ends up higher. And we're looking at, well, a slightly steeper yield curve, Fate.
You are indeed. We're looking at, what, 2%? Oh, yeah, we're above 2%. We're up 7 basis points on 20s and 30s. We could do this all day long. Stay with us. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From Bloomberg's World Headquarters in New York, I'm Caroline High.
I'm Romaine Bostick.
I'm Taylor Riggs.
Well, guess what? Today was a Fed meeting, if you didn't know. There's been a lot of talk, of course, about that taper. We got the taper. Today, the timeline from the Fed, it was laid out there. Starting this month, the Fed is going to reduce purchases by $15 billion, what the street was expecting. This marks the beginning of the end of a program that was aimed at shielding the economy from the COVID pandemic. Fed Chair Jay Powell also stressing that the central bank can be patient on when it will raise rates, but it will take action if warranted by inflation. As a result, stocks hit record highs and the Treasury curve steepened. Take a listen to what Jay Powell has to say as he laid out the next steps for the Fed.
It is time to taper, we think, because the economy has achieved substantial further progress toward our goals. We are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes, and that's what we need to do. I do think it would be premature to raise rates today. That's not. I don't think that's controversial. We want to see the labor market heal further, and we have very good reason to think that that will happen as the Delta variant declines. Inflation has come in higher than expected, and bottlenecks have been more persistent and more prevalent. We see that just like everybody else does, and we see that they're now on track to persist well into next year. We think we can be patient. If a response is called for, we will not hesitate.
Here with reaction to Powell's comments, Kathy Bostjancic, Oxford Economics Director of U.S. Macro Investor Services. Kathy, I want to start with what Powell was mentioning at the top of that soundbite that we had, namely about the tapering of the asset purchases. We have November and December, but we don't yet know the schedule for 2022. And BMO Capital Markets, for one, was saying that $15 billion a month is binary. That's sort of the max. And then it could be less. How are you thinking about a schedule of a taper?
So, Taylor, we've been thinking for a while that it would be $15 billion per month. It's really just straightforward, easy to communicate to the markets, as close to seeing paint dry as possible, as Janet Yellen had previously said. They really just want this to be an unwind, as was said earlier, of the emergency actions that were taken, and they really do want to delink that from prospective interest rate hikes. Now, could they change the pace? They could. It could be a little faster, or it could be a little bit slower. It seems to me that the risk would be it'd be a little bit faster, given that inflation lies on the upside, but that remains to be seen.
And indeed, that flattening of the yield curve was because the market was anticipating perhaps a Fed hike at a faster pace than much of the market had anticipated previously. But you didn't. You were looking for a slower rate path in general. How bad do the supply chain constraints need to get? How poor do the inflation readings need to be for you to think that slower rate path becomes, once again, a higher one that the market had previously been fearing?
Well, that's a good question. We're all trying to, wrap our arms around, the supply chain disruptions, when they'll start to ease. Our view does, for the moment, sync with the Fed's. We think that sometime by the middle of next year, we'll see a material easing of supply chain constraints, and that inflation will decelerate quite markedly. And that's really the key. By Q2, Q3 next year, we need to see that happen. But I would say in the near near term, we're probably going to see worse inflation numbers, unfortunately, because these supply disruptions look like they're getting worse. We have an in-house measure of that as best as we can, and other measures suggest it's actually getting worse. So it'll probably get worse before it gets better.
This all, of course, came on a day where we got the latest refunding announcement from the Treasury. There's been a lot of talk about the debt needs based on the fiscal policy that we're getting here. This wasn't really addressed in any sort of detail during the press conference here, but I would think that policymakers at least have to have this on their mind, at least when they get to the latter stages of this tapering and the idea that full policy support could start to be removed.
Well, I think that, for now, the key for the Fed, and it obviously they don't do it with an eye towards Treasury or helping to fund the deficit, but I think the key for the Federal Reserve is keeping inflation expectations under wraps. So if for some reason they need to move more quickly, as Powell said they will, but as long as, long-term rates don't rise too much, yes, the curve steepened a bit, a few basis points, but as long as they can kind of keep a handle on that, that should also help with the funding and the borrowing levels that we'll see.
Kathy, I think what is interesting, and there were a few questions on this, what is QE? What does this bond purchasing program per month do? Because if the issues are around the supply chain, it's not a demand story. Demand is there and it is strong. What then are monthly bond purchases doing to fix the problem, which is supply chains?
With regard to supply chains, nothing, frankly. They need to work their way out on their own, and private companies taking some action and maybe demand over time easing. But nothing really that in terms of monetary policy can really affect supply chains. The Fed can only react to it. Winding down the QEs just makes sense at this point. You don't need these emergency actions. And in a way, QE is becoming a signal, right, for the next step, which is what we're all looking at, is when does the Fed start to raise rates and how quickly?
Is there not a case, though, that then they should be going faster, given it's not solving the problem?
If they go quicker, it's a great question. I mean, if they go quicker, then the market's going to interpret that as, rate hikes are going to become quicker than expected. And then, the front end becomes under pressure and we see a flattening of the yield curve again. So I think Chairman Powell actually walked the fine line pretty well today and accomplished probably what he wanted to.
How important do the jobs data now become? What numbers do you look out for? Because we're about to have a deep discussion about bond vigilantes and how much pressure the bond market had been putting on potentially the Fed, maybe fiscal policy just a month or so ago. Do we ever get that reprise again, Kathy?
Well, the Friday's number looms large. I think, all of the, going forward each month, the payroll data will be very important. So we'll be looking at the overall number, of course. We're looking at the labor participation rate, which Chairman Powell addressed quite a bit today. Are the workers going to come back to the labor force, and how quickly will that happen? And then, of course, wages will be very important. How quickly is wage growth picking up? All three of those factors are really quite important. And I guess on the fiscal policy front, we'll have to wait and see. Things there still look pretty uncertain.
They certainly do. Thank you so much, Kathy Bostancic, of course, Oxford Economics Director of US Macro Investors Services. Coming up, we're going to be talking just about that, bond vigilantes. The man who coined the term, Ed Yardeni of Yardeni Research, talked about it in the 1980s. Well, they've been back of late. Will the Federal Reserve have done enough to stay those vigilantes for the time being? We'll discuss. This is Bloomberg.
Проходим опасный участок, ответственный. Рустам поднимается на Жумаре. Шерпа страхует.
очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
Okay, today we are focused, of course, on the Fed after the FOMC decision and taper timeline. It also, of course, was a little bit earlier that we had the US Treasury coming out with an announcement. The first reduction in its quarterly sales of longer-term debt, more than 5 years. Romain, you've been looking actually at the issuance side as well as the bond buying side.
Yeah, there's a direct link here, too, I mean, to the announcement we got today, and I guess the potential, as people want to talk about bond vigilantism. Our next guest, of course, coined that term back in his old days at E.F. Hutton here. But there's been an issue, and Cameron Christ created this chart, and it's a good point here that he's making here, that one of the reasons why you haven't seen that type of vigilantism is, well, there's really no room for them right now. I mean, basically what this chart is telling you is that everything out there, at least on a net basis, is being absorbed not by the private sector, but basically by Fed or Fed policies, as well as purchases from other central banks here. So basically, the Treasury issuance that's going out there is either being bought by our own government or by other governments, and that's taken not only pressure off the private market, but at the same time, it's usurped a lot of their power to really push back.
And in help driven a lot of the commentary that we've heard this week that it's technicals as much as we want to say it's all about fundamentals when we get these moves. Perhaps maybe some of those technicals are coming in to play. Let's get more insight on this from, as Romain said, the man who coined the phrase bond vigilantes. Joining us, Ed Yardeni, president and CIO of Yardeni Research. Talk to us about some of the vigilantes that you are starting to see, if you are. Of course, some calmness around Jay Powell. Right. And then as we get up here now, a lift up of 7 basis points or so. You're above 2% on the 20s, 30s. Do you start to see a beginning of this vigilante?
Well, I think the Fed really does have to step out of the way before the vigilantes can have much of an impact on the bond market. You know, we keep using the phrase bond market like it's actually a market. The fact of the matter is it's been jerry-rigged by the central bank. The Fed's been coming in and buying $120 billion per month in treasuries and in mortgage-backed securities. No wonder that the bond vigilantes can't do very much about some of the issues that are out there, like inflation and like huge deficits. Without the Fed being in the market like that, I think we would probably see the bond yield easily over 2%. But instead, it's been steady right around 1.5%. Not that steady, but it's been around 1.5% with some volatility.
Yeah. There's a question, though, and I guess a lot of sort of, I guess, parlor bets out there as to not only when the Fed sort of removes itself from the equation, but whether it's even in a position to really do so here. I mean, has the Fed and really the government overall kind of backed itself into a corner where, at least for the foreseeable future, this is the normal?
Yeah, I think that's a very, very good point, because the reality is because the central bank has kept interest rates so low, credit conditions so easy, people have been borrowing like mad, particularly the people who are running the government. And that means we've accumulated an enormous amount of debt, which also means that it probably won't take that much of an increase in short and long-term rates to have an impact on slowing the economy down and maybe even creating the next financial crisis.
Do you think that you can get that type of meaningful shift in policy where they're removing themselves from the equation without too much disruption? Or is this going to be one of these sort of Paul Volcker-esque types of moments with regards to monetary policy where somebody has to come in and just completely shock the system?
Yeah, I mean, Paul Volcker was an amazing central banker. He was kind of one of the last really, truly conservative central bankers whose main concern was to keep a lid on inflation. And ever since then, we've had a much more balanced Fed, some people would say, or one that's prone to let inflation get out of hand. Now, a lot of things went right over the past couple of decades on inflation, so the central bank didn't have to worry about inflation. Now, a lot of things are going wrong on inflation, and some would argue, and I would say as well, that the Fed, contrary to what Powell said today, is in fact behind the curve on inflation, and is at some point going to have to maybe move a little bit faster on tapering and then raising interest rates. But as you said, then they're going to be stymied. I think this Fed is going to be even more liberal next year than they were this year with monetary policy. I think they're going to raise the inflation target. I think inflation is going to remain somewhat persistent, and that means that they're not going to get back to 2%. They're going to be stuck around 3%, maybe 3.5%. And they say, okay, that's our new target, 3%. Live with it.
And it's interesting that, of course, Taylor over here gets deeply excited about rate of change. And rate of change for us in the bond market is now 5 basis points. It used to be back in the 80s and 90s a lot more than that. Absolutely. When you're talking about a sort of a rigged, quote unquote, I'm not using your exact tenor phrase, market when it comes to the Federal Reserve in the bond market, do we want to ever go back to what it used to be like in the 80s and the 90s? Do you want the push and the pull of those private sector maneuvers that could make for a very volatile treasury market?
Well, you know, it's my own personal preference is that free markets be allowed to be free, that we don't have the government so meddlesome and intervening in such a regular basis in the credit markets. I mean, the Fed is just has become way too important in the credit markets, and the credit markets and the bond vigilantes should be given a chance to make a comeback here and to regulate some of what's going on in the economy. Otherwise, we risk politicizing the capital markets. As it is, the Fed has become more politicized. It's become more liberal, more progressive, and I think it's going to be even more so next year. If Powell's not reappointed, then it's probably going to be somebody that's more progressive than he is.
And you're saying that someone could be Lael Brainerd. Why?
Absolutely. It could be Lael Brainerd. There's a couple of other people that might fit the role, but Lael Brainerd's been a Democrat and certainly more of a progressive than Powell. Powell's liberalism really came out with the pandemic, and he reversed the Fed's mandate from giving equal weight to unemployment and inflation, keeping inflation down, keeping unemployment down, to giving more weight to keeping unemployment down. So that's clearly much more in tune with the progressive policies of the current administration. But he's only been doing it since the pandemic, whereas Lael Brainerd, I think her credentials as a progressive are much better.
Yeah. All right, Ed, we're going to have to leave it there. Always great to catch up with you. Ed Yardeni, of course, president of Yardeni Research here. Some pretty interesting calls here about, I guess, the future of monetary policy and, more importantly, the future of who might be leading it.
I should apologize and issue a copyright. I did a fixed income research called The Return of the Bond Vigilantes, and I should have maybe given him a little copyright note. I'll have to go back and tell my professor that. I got an A, I think, though.
You got an A?
Thanks to Ed.
Of course you did.
We're going to give Ed credit for that.
All right, coming up, we're going to be back with our overachiever, Taylor Riggs, and we're also going to talk about swings in global yield curves and how they're spurring losses in hedge funds with our next guest, who's also a bit of an overachiever himself. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Даже это не пробовать, вот в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
It's
up.
a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Today, we're focused on the Fed, and it's been a tough year for some of the world's most well-regarded macro hedge funds. Names like Blue Crest Capital, Exodus Point, Point72, Alpha-Dyne Asset Management. And while the cost seems to be tied to those wild fluctuations in yield curves across the globe, all essential bankers are beginning to react to, well, persistently elevated inflation. Losses piled up, and for a few became so big that the firms halted some trading to help contain the damage. Let's bring in our Bloomberg opinion columnist, Brian Chapata, for more. And we were just coming off of a great conversation about how some of these moves are more technical than they are fundamental in nature. And is that what's causing perhaps maybe some of the outsized swings that we're seeing?
Yeah, I mean, I would say the reason that they're technical in nature is because these big names probably were stopped out of their positions. It's pretty crazy because, as I wrote last week, they are some of the best rates traders by far in the world. You look at like some of the rosters of these hedge funds, their former head of rates at places like Goldman Sachs, Morgan Stanley. I mean, all the big banks, they leave, they join these hedge funds, and they just got completely burned by the move in short-term rates. Not so much in the U.S. even, but like you look at the U.K. and the way that rate hikes are priced in for the Bank of England, big decision tomorrow, as well as in Australia. They are no longer defending their yield curve down there. Real interesting moves and some real big losses from places like Alpha-Dyne and all the other names that you mentioned.
What's also interesting, though, is from a historical perspective, with Ed Yardeni, we were kind of saying that the bond moves just aren't that big in comparison to what they used to be like in the 80s and 90s. So what is going so wrong with the way that these particular hedge funds are playing it?
Yeah, I mean, what's really funny is that the actual total return loss on 2-year notes, right, in the U.S. is very small. It's less than 1%. But the 2-year note has never lost money on an annual basis ever, because it's just the roll, the interest rate, but yields are so low right now, rates are so low right now that even just a small move ends up magnifying the losses for a lot of these hedge funds. So a lot of them were presumably quite levered up, anticipating that things would be pretty stable on the front end of the curve, and it just didn't play out that way.
So just to be clear, though, this was also partly a timing issue, though, right? I mean, or I should say, rather, the pace of the change, rather than the fact that things were going to change at all.
Oh, yeah. I mean, you looked at the 2-year or 3-year Australian yield, and some people joked on Twitter. They're like, "Oh, is this the latest, cryptocurrency?"
Yeah,
that's the latest fad, because it was just a straight up.
People were really joking about it.
People were really joking.
Did you laugh? Did you laugh when you saw that?
It is on my Twitter feed. I will send it to you after this. Yeah.
Okay.
Finance people make jokes.
That's CFA. Is that CFA humor?
Yes.
What chapter is that?
You could say we're not laughing right now.
There isn't any crypto in the
pass rates
CFA.
are
I don't know
so
what you're
right
talking
now
about.
that we're not laughing about the CFA right
Did I tell you I took one of those tests? Oh, and the pass rate was like at a record low, and I still got through.
Because you were a star.
Yeah.
And we all just are figuring.
I'm not taking.
Who's the overachiever now?
I'm not taking the CFA until they start talking about crypto.
I think actually, was it included? We could go off on a whole tangent on this. There actually might be a little bit of a crypto segment, so we might
maybe
have
the
to
underlying blockchain.
Wow.
Hold you up on that, the underlying blockchain. Producers kindly telling us to get back on track. Bill Dudley had a really interesting Bloomberg opinion column this morning. Caroline sort of hinted on it about the absolute levels that are so low. Ed Yardeni said that watch out, inflation, it may not be 2%. We could be looking at 3.5%. That's going to be the new target, and you're going to have to get over it. That also then says that neutral rate of the Fed actually then could be higher, and a peak rate hike in this cycle could be higher than it has been in previous cycles. Does that help sort of get us off that zero bound more so? And actually, is that what they wanted all along?
All of that makes sense to me, honestly, but the zero lower bound seems to be where a lot of central banks are comfortable right now, and the Fed's comfortable there. They're saying we want to keep rates at zero until we have maximum employment and inflation that is 2% and on track to moderately exceed 2% for some time. They want to keep it there. But what was interesting at the press conference was that Jerome Powell said that right now the current levels of inflation are not consistent with our price stability mandate. Said that flat out. If you see 4% core inflation or whatever we're at right now, I think 3.6 maybe on core PCE, that is not consistent with what we want. And he acknowledged that it does hurt people, especially those who are living paycheck to paycheck and have to pay more for essentials. So it will be interesting to see how they balance that. Right now, he's being patient, saying let the supply chain bottlenecks work themselves out because we can't get a clean read of the economy right now.
And you're going to have more of a read on the wage inflation as well, which apparently is just one number. Just one number, but we'll see if it continues to be more of a theme. Bloomberg opinion columnist Brian Chapata, always so smart, him with all his CFAs.
He started at muni bonds, that's why.
Of course. Maybe we should all go back to just doing munis.
When do we do final thoughts?
Romaine, it's now. So
would you like a thought on muni bonds?
No, muni bonds, no, of course not. But I do think, in all seriousness, this was a day that, of course, a lot of people anticipated. They got exactly what they were looking for. But I think this really is now sort of that countdown to whether you believe in the inflation story, whether it's what's coming out of the Fed's mouth or not, and whether you believe that rate hike is truly decoupled from this tapering cycle.
Transitory, he's capitulated. Transitory means different things to different people, and seemingly it means out until mid-2022.
Did you hear the first question that guy asked him? Well, it was a stunner. It was great. We don't have time.
Did we have the last question again?
That's going to be on tomorrow's Final Thoughts. This is Bloomberg.
Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
from New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, a tale of failure, mistrust, and hot housing markets. It is the Zillow saga. Now Twitter and TikTok users are raging against the real estate firm as it looks to sell 7,000 homes for a whopping $2.8 billion. The message of the digital protesters, don't buy them. Why? We'll have all the details. Plus, much more than sneakers. Lifestyle brand Allbirds hits the public markets, hitting a $2.1 billion market cap. We will speak to the CEO this hour. And the demand for ride-hailing is back. Lyft reporting a 73% jump in third quarter revenue and saying the company will turn a profit for the year. We'll speak to Lyft President John Zimmer and ask if driver supply can keep up. All that in a moment, but first let's get a look at the market. Stocks climbing to a record after the Fed signaled monetary policy will stay flexible. Kriti Gupta with us for more. Kriti, take it away.
Well, Emily, it is all about the Fed. Tech actually outperforming, leading the S&P 500 to a record high, and all because the Fed stayed on message. $15 billion of tapering. That is what they've said they're going to start in November, continue that into the next couple of months, and perhaps get this kind of inflation that we're starting to see under control. Still sticking to the transitory message, but that was exactly what markets need to hear, specifically tech stocks, which have been extra sensitive to those inflation concerns. And you can see right behind me, the S&P 500 up 0.6%, closing at session highs. The NASDAQ up a whopping 1%. Of course, you see those yields higher as well in anticipation. I want to get to some earnings stories, though, hit a little bit of the micro, because Qualcomm just reported a pretty upbeat forecast. Shares up after hours. A lot of this coming off surging 5G demand. Now, remember, the CEO has made a really big effort for this company to diversify some of their suppliers. So some of this beat is actually because they have been a little more insulated when it comes to that supply chain crunch. A different story when it comes to Etsy, dropping after hours, 3.6% lower after the market closed. This has everything to do with that e-commerce boom in 2020 is starting to fade here. They gave a lackluster forecast into the holiday period following the likes of Amazon, for example. I want to hit Zillow, though, because that's the other story we have to talk about, taking a massive hit today, 25% after saying it's actually going to halt its house flipping business altogether. This comes 7,000 homes. You mentioned it in your intro, but also looking for about $570 million in write-down. So a lot going on here, taking with it some of its peers, Redfin and Opendoor. Emily.
All right, Kriti, thank you for that roundup. Well, what was once a hot housing project for Zillow has become a total nightmare. The real estate company is pulling the plug on its tech-powered home flipping operation. Shares plummeting since the news, down another 24% today. The company is now trying to offload 7,000 homes to institutional investors for $2.8 billion. To walk us through the details, we are joined by Bloomberg's Patrick Clark. And Patrick, you broke the story that Zillow was pausing its home buying business, and we have just seen the stock plummet since then. Now this news, they're offloading these 7,000 homes. What went wrong here?
It's really hard to, it's still, I would say, hard to say. I mean,
a big part of what went wrong is they bought homes for more than they could sell them for, kind of as simple as that. They leaned into the really rabid home price appreciation this year. Home prices cooled a little bit on them. They went to go sell homes. They couldn't get as much money as they wanted for them. And along with that came a bunch of other problems. Didn't have enough workers to repaint the walls, replace the carpets and do whatever other repairs they wanted to do before they sold the homes on. But at the end of the day, they decided that they were wrong once in a big way, and it was too big a risk that they would get bigger in this business and be wrong again.
When Zillow got into this business, I honestly do remember thinking, that sounds like a hard business. Was this really a legitimate business?
A legitimate business? Yeah, it could be a legitimate business. You can, the problem that they want to solve is real, which is that it's a real pain to try to sell your house, especially if you're trying to buy a home at the same time. And if somebody comes around and makes you a cash offer and gives you flexibility for when you're going to set your closing date, that can take a lot of the headache out of it. Whether you can buy homes from people at a price where they feel like they're getting a good deal and you can still make money on the other side is the open question, and Zillow clearly struggled to do that.
Now, this Twitter and TikTok protest, folks saying don't buy Zillow homes, why is everyone so up in arms about this?
It's been it's been a really tough year and a half if you want to buy a home, particularly if you're a first-time home buyer looking for an entry-level priced home in Phoenix or Dallas or Vegas, Nashville, the types of cities that are seeing a lot of in-migration. If you're in that housing market, the appearance of, the Zillows and its competitors, Open Door and OfferPad, and Redfin competes a bit in this business as well. Plus the large single-family rental companies, Invitation Homes, American Homes for Rent, a bunch of private equity players. You see these giant institutions with billions of dollars that can come in and make a cash offer for a house, and meanwhile, you have to go through this more complicated process, getting a loan. If you're a low down payment borrower, you've got to get the home appraised. I think it's a widespread frustration with institutional presence in these very hot housing markets. Part of it may be that the institutional presence isn't well understood. Was Zillow really making it harder for a regular person to buy a home? Possibly in some ways, but in some ways, they may have been making the experience of the housing market better for people. But it's a very emotional issue, and in fact, it's sort of attracted political heat from both the left and the right. So I don't see any indication from Zillow. If you ask Zillow directly, did you not like the sort of optics of this business? I've not heard anyone from Zillow say, yeah, that was the issue. But it's a fair question. This is a company that does have a beloved consumer brand in real estate search, right? I mean, it's only a few months ago, Saturday Night Live was making a sketch about how browsing Zillow listings was like the new great adult pastime. So I have to think that seeing people calling them evil on Twitter and TikTok doesn't feel great.
Well, if they need to pick me up, they can go back and watch that SNL skit because it was pretty funny. But 36% drop in the stock, not funny at all. Patrick Clark, Bloomberg News real estate reporter. Great reporting from you on this. We'll continue to watch what you put out. Meantime, Alphabet's self-driving car unit Waymo says it'll begin mapping New York City streets. This will pave the way for the potential deployment of its autonomous taxi service in one of the most dynamic urban environments in the country. Expanding operations to New York shows Waymo is stepping up efforts as rivals like Cruise make progress on setting up competing services. Coming up, sustainable shoe company Allbirds leaps in its debut after an upsized IPO. We'll catch up with co-founder and CEO Joey Zwillinger next. This is Bloomberg.
ad when you use Ecosia and click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
Allbirds, known for its hip but sustainable shoes, has just gone public in an upsized debut. Allbirds more than doubled briefly during trading after its initial public offering topped the shoemaker's goal to raise $303 million. The listing is one of 417 on U.S. exchanges that have raised an all-time high of more than $137 billion, according to data compiled by Bloomberg. That does not include SPACs. For more, I want to bring in Allbirds co-founder and CEO Joey Zwillinger. Joey, huge day for you after a long journey. What's the plan for this new capital?
Yeah, it's a really quite a big moment for the company, obviously, only being 5 years old, and we're clearly really excited and had the great fortune of having a bunch of the very early employees out for the day. And about to do a little celebration, but we'll take the money and we'll continue to put one foot in front of the other, so to speak. And a big use of our proceeds is going to go to a couple areas of growth. Really, the first is our U.S. brick and mortar retail. In particular, we're growing at a very good clip now that retail is recovering significantly, and traffic in the stores are doing great in almost all parts of the country now. So we'll be building a lot of really great stores around the country, and we're also focused on a couple key international regions, a couple in Asia and a couple in Europe. And so we're really focused in doubling down from what is a great start, but a really small one in those markets.
So shares up 92%. Are you looking at that number and thinking, gosh, we should have raised the price so we could have raised more money, or maybe we should have done a direct listing? I mean, how do you think about that? I know that it's, you're mostly celebrating today, but is that at all in the back of your mind?
I will say it was a very difficult thing to quantify. This is always a bit of a black box. And, I've looked back and said, God, I'm never going to be that idiot CEO that has that kind of a pop unless the financial world win. But in reality, I think as we've gone through the process, we had an incredible amount of demand from institutional investors in a way that was quite overwhelming. It was a very it was really a rewarding roadshow experience, talking with many different dozens of investors that were world class. And two factors that really played into this that made the uncertainty just a lot bigger. The first is we're a retail brand, and people have come to love our products, and a lot of those people like to be retail investors too. So we expected some activity, but it's really hard to understand what's going to come in the aftermarket from retail. So that was the first one that was really hard to read. And the second was being such an authentic leader in the ESG space. That resonated very strongly with the investment community, and we reached a number of different pockets of capital that I think businesses that aren't as focused on stakeholders that are non-financial don't have access to. And so again, really difficult for us to quantify what the impact of that was and how they were going to come in at the IPO and in the aftermarket, and what's going to happen from here, frankly. So we're encouraged by all the demand. That's all we can kind of go to bed happy for the outcome.
Sustainability has been the key principle for you from the beginning. An average pair of Allbirds has a carbon footprint 30% smaller than a typical pair of sneakers. Curious what kind of supply chain issues you might be seeing now and how you're navigating them. Like, if we want Allbirds for the holidays, should we be ordering them now?
you know, we got you now and we got you later. We wouldn't have gone public today if we had disruptions in our supply chain. And we've had a fabulous outcome from our team's effort and some good luck. And fortunately, we have all the inventory in place to serve everyone this holiday and well into next year as well. So that was a big factor in having a very little uncertainty from supply chain for us to come to market. And we see retail recovering, tourists are coming back and traveling internationally. And we have such an exciting product portfolio coming in the performance space, trail running shoes we just launched, and a number of other exciting products that, you know, it's the best the company's ever offered to consumers. So a great backdrop for us to come to market.
Allbirds has been the shoe for the tech industry. The uniform is kind of like a Patagonia fleece and a pair of Allbirds. And I'm curious, you know, is it still going to be the cool thing? How do you, you know, keep on trend and make sure this is still what people want to wear?
Well, I mean, fortunately, we have a really broad base of consumers. It's geographically dispersed across the country and also around the world. And we're finding that this health and wellness orientation of our customer, it's quite young. It's actually much more female than it is male. And we find a resonance with a really broad group of customers and consumers, a lot in creative industries. And you know, I put some of technology into that bucket. And as we continue to innovate, continue to broaden our assortment, I think we're meeting a lot of new customers, and we're finding that much of the stuff we put out today is resonating with particular audiences. And given we're a vertical brand, we can really start thinking about how to design and create great products and great experiences for customers and tailor make them for what they're looking for, given we have the data.
All right. Well, good to know you got your customers now and later, especially ahead of a busy holiday season. Joey Zwillinger, Allbirds co-founder and CEO, thanks so much for stopping by. Coming up, a dire warning from the top U.S. cybersecurity official amidst a wave of cyber attacks against critical American infrastructure. What can be done to stop it? We'll discuss next. And as we head to break, let's look at shares of Qualcomm, up about 5% in late trading. The world's largest smartphone chip maker giving a stronger than expected outlook for the current quarter. That was lifted by surging demand for 5G devices and the company's push into new markets. We'll talk to CEO Cristiano Amon tomorrow right here on Bloomberg Technology. You don't want to miss it. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As the pandemic fades, will job restoration accelerate? Will a tight labor market push wages up?
I don't think we've ever had a hotter jobs market.
Tune in for the October Jobs Report Friday on Bloomberg Television and Radio.
All right, we are watching Ethereum. It is up more than 30% in the last month to a record high year to date. Ether up about 500%. Bitcoin up only 120%. Now there's talk of an Ether ETF by early next year. And a warning from the director of the U.S. Cybersecurity and Infrastructure Security Agency. The American way of life faces nearly daily threats from ransomware attacks to the country's critical infrastructure. For more on this, I'm joined by Jamil Jaffer. He is the co-founder and executive director of the National Security Institute and a national security expert who also served in the White House during the George W. Bush administration. So what do you make, Jamil, of these latest comments from CISA? And, I'm sure it seems obvious to you, but it still seems to be difficult to get, folks across the administration on board.
Sure. Well, Emily, one of the challenges with these ransomware attacks that we've seen a lot of is that they're coming from a variety of groups, right? We see them coming from criminal groups. We've heard some discussion about whether nation states are involved in them or not, right? So the question becomes, what's the government's role here? But I think what's really concretized it for the American public is the attacks on Colonial Pipeline, the attacks on hospitals, the attacks on water supplies, food supplies. We've now seen this ransomware spread in ways that really affect the average day-to-day lives of Americans. And that's what's got them really exercise about it, that is to say the American people, and that's got the government paying a lot more attention. And so you see now the government talking about how it needs to do better on its own defense. That's what today Jen Easterly at CISA was talking about, and how to make that more effective and how to get better at specific vulnerabilities that the government has today and how to address those immediately.
I'm thinking of an attack on a hospital in Alabama where a baby literally died because hackers disabled computers and medical staff could not monitor them. The CEO of Microsoft, Satya Nadella, told me cyber attacks are the new pandemic. Is that how you would describe it? And how do we get everyday people to understand how big a threat this is?
Yeah, I think Satya's exactly right. I mean, an epidemic here in the United States, a pandemic around the globe. We see these attacks spreading more broadly than we've ever seen before, and attacking and coming after more critical infrastructures. And so you take the case of this young woman who came in 2019, comes into a hospital in Alabama, Ms. Kidd. She has her child. There were everyone was focused on the cyber attack. And so while stuff was going on with the cyber attack, the doctors are texting each other back and forth. They're not able to communicate effectively. And there were just less eyes on the baby's heart monitor. And 9 months later, the baby passes away, born with an umbilical cord wrapped around its neck. Terrible incident, right? And you can tie it back to some of these incidents that happen. There are even more direct ties if you think about, what might happen if a water supply were affected or if the power went out and services weren't available. And so as we're seeing more of this, we're realizing that this is a concrete challenge for people. Part of the problem, Emily, though, is, we become accustomed to lots of cyber breaches. Our data is lost, right? Our identity is gone, right? So people are somewhat jaded when it comes to cyber attacks or cyber hacks. But these attacks are fundamentally different because they affect critical infrastructure and they make it unavailable potentially for some period of time.
Meantime, there's an organization, a Russian organization called Black Matter, a ransomware service that claims it shut down this week, which would seem like a win. Is it?
Well, it's hard to know. We've seen a lot of these other ransomware services shut down. We saw our Evil go down and the like. But what oftentimes you have happening is sometimes they're rebranding themselves, right? They've seen some of their compatriots taken down by law enforcement. So they're like, shut down, we'll come back in a different form. One of the things about Black Matter was that they were ransomware as a service. So they were offering ransomware to other people for part of the cut of it, right? And so they may have shut that down, but they may also still be doing it on their own. And of course, the real question is why did they shut down? What was this law enforcement activity? Was it an allied nation? Was it the Russians, as some have argued? Was it another Eastern European nation? We don't know for sure, but their claim is law enforcement came after us. We decided to shut down. So a win at some level, but perhaps not as big as we might have otherwise hoped.
So do you think that the current administration understands the severity of these attacks and really has a concrete plan to address them?
Look, I think they've appointed a terrific group of people. Jen Easterly at CISA has a long experience from NSA and Cyber Command. She stood up the initial things there. She was at Goldman Sachs recently. Chris Inglis, a cyber leader, the former deputy director of NSA, now the national cyber director, and Neuberger as deputy national security advisor. Rob Joyce is back at NSA as new cybersecurity director. So and Paul Nakasone at NSA and Cyber Command. You have the ideal team to get this right, and you see the government doing stuff on its own side. But now the key key, Emily, to me is how does the government come together with industry, create that interplay between the public and private, industry with industry with government, create that collective security? Because we know, look, Emily, asking one company alone, standing alone to beat the Russians or the Chinese or the Iranians or North Koreans, it's completely ineffective. It's got to be a team sport, as Chris Inglis described it. And so now that they've gotten this team together, we've got to free them up to do what they need to do, which is bring the nation together, bring industry together with government, and really engage in collective defense.
Are ransomware attacks going to get worse? And are they going to get worse and then potentially get better? I mean, what's next?
Well, we have a lot of focus on ransomware because it's the current thing that's hitting us. But, ransomware is a part of a larger malware problem that we've had for a long time. And unfortunately, I do think that malware problem is going to get worse before it gets better, in part because we need this collective defense capability. What we also need, though, is exact costs from our adversaries. We know that in some cases, the Russians, the Chinese, the Iranians, the North Koreans are helping fund these criminal groups. They're also allowing them to operate. In a lot of ways, you've got to treat cyber criminality the same way you treat terrorism, which is we're going to hold the nation states that allow these actions to operate liable for the actions of these actors. And so until we start doing that and really start imposing costs and get our defense better, unfortunately, I think it's going to get worse before it gets better, Emily.
That's pretty extreme to treat cyber criminals just like terrorists. Why?
Well, look, I think that right now the way it's working is in China and Russia, we've long seen a lot of interplay between cyber hackers, cyber attackers, the criminals, and the government. A lot of times the guys that are working for the government, the men and women that work for the government, will go home and hack in their free time, trying to make money for their own pocketbooks. They're also paying off some of these nation states, and so that's part of the challenge. We've long seen that in Russia. We're seeing more of that in China, and so we know they know what's happening. If we don't hold them accountable, we're going to see more and more of this. I think that's the real fundamental challenge.
Okay. Jamil Jaffer, founder and executive director of the National Security Institute at George Mason University. Thank you, as always, for giving it to us straight. Coming up, the recovery is on in the rideshare business. I'll speak with the president and co-founder of Lyft after a strong third quarter. Up next, this is Bloomberg.
Energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. I want to get back to the markets with our Kriti Gupta, taking a look at ride-hailing companies after Lyft's impressive results. Kriti, what are you looking at?
Yeah, I mean, Lyft, Uber really blowing us away, but really let's start macro here because a lot of this has to do with the Fed today with $15 billion taper, exactly what the market was expecting, helping tech broadly lift the S&P 500 to new records, and with it, taking some of these tech subsectors, semiconductors, Chinese ADRs, which of course is that tech-heavy index, and even that NASDAQ biotech index ending in the green. Emily, it did not start the session out that way, so a real turnaround story for tech and the broader benchmarks. I want to hit Activision, though, before we hit Lyft, because this is going to be a major story, having its worst day, a 14% loss since all the way going back to 2008. This is, of course, after two of its most highly anticipated games was put on the back burner, delayed, and on top of that, missing some of their earnings estimates, and a triple whammy, Emily, getting downgrades from several of Wall Street's banks. So not a good day for Activision. I want to finally get to Lyft and Uber because a completely different story when you get to those ride-hailing giants. Lyft in particular coming out a very upbeat forecast, a 73% year-over-year jump in revenue, 51% increase in riders, and on top of that, Emily, the cherry on top, saying that they can actually turn a profit by the end of the year, or for the full year, say, even before taking out taxes, etc. So this is really good news for Lyft. You can see a 8% gain in intraday, and taking with it its competitor Uber, of course.
All right, Kriti, thanks for that. Well, let's now talk to the man himself. An impressive showing, as Kriti said, from Lyft. Clear that ride-sharing is recovering as the pandemic moves slowly into the rearview mirror and life returns to some semblance of normal. For more, I'm joined by the president and co-founder of Lyft, John Zimmer. John, good to have you back with us. Let's start with rider demand. What are you seeing?
Sounds good. What's that? Sorry.
Let's start with rider demand. I mean, obviously, people are riding again. What are the more specific trends that you're seeing?
Yeah, so we had 2 million more riders this quarter than the previous quarter. That's great to see. As you just mentioned, 73% revenue growth year over year. People are ready to get back out there. At airports specifically, we saw triple the volume than what we saw a year ago. So things are coming back. They're not all the way back. There are markets like San Francisco, where we're still 60% down from that peak and call it Q4 2019. But even with that, able to hit those adjusted EBITDA profitability numbers that we're happy with, but more to come.
Now, airport rides were a strong driver, and I'm curious how dependent Lyft is on business travel, just in case the pandemic isn't totally back in that rearview mirror. And we see another surge, especially over the holidays.
Sure. Just to put the airport number into more context, I believe pre-pandemic, it approached almost or over 9% of our revenue was that airport trip. And we're already at about 8%. So again, still more to go. But it's coming back in that mix shift is almost where it was prior.
Now, let's talk about driver supply, because anecdotally, wait times are still longer than they were pre-pandemic. At what point do you see that coming down and being more reliable, back to the way it was?
Yeah, good progress on that front as well. 45% year-over-year growth on the driver's side. We're zooming out and looking at just the labor market more generally this quarter, and we looked at the hospitality and leisure sector as well as the retail sector. And what we saw is that from January to September, our driver actives grew 5 times faster than labor in those other, call them comparable industries. So I think what we're seeing, yes, there's still a pandemic. Workers are still coming back to work, getting off those UI benefits. But our type of work, where you can turn it on and off whenever you want and still have flexibility that people really appreciated during the pandemic, I think will do well going forward. So we're really happy with those growth signs that we saw this quarter.
What can you share about what you're spending on driver incentives? I know that's been, obviously a big initiative in order to get things back on track.
What we said is that Q2, so not the quarter we just reported on, but actually the previous quarter was the peak on that spend on a per ride basis. And so there will always be, some aspect of balancing supply and demand. But we feel like we've hit that peak and that we can taper off some of those more extreme investments that were related to the pandemic.
And prices are still higher as well. Look, I know we're working towards normal, but we're still not quite there yet. And it's, not just Lyft, it is Uber as well. Are you at all concerned about ceding share to Uber in ride hailing during this time? Because they also have the food delivery business, and that's another way to hook in customers.
We're not concerned because, one, it hasn't happened. So if you look pre-pandemic numbers on share and now we've maintained share. And we're not going to, the back and forth between the businesses, the companies are very competitive. We're very competitive. And we want to serve our customers and drivers better than anyone. That said, we're not going to do that through a price war. We're going to do that through better services, better products, and an overall better strategy.
And there is a wider conversation about wages happening. Look, every time, Dara Khosrowshahi is on the show, or Tony Xu, the CEO of DoorDash, or even Fiji Simo of Instacart, I'm getting feedback on Twitter from contractors, drivers who want to be paid more. What are you doing to make driving a really compelling job, especially over the holidays when there are other opportunities out there? For example, Amazon hiring thousands of temporary workers to get them through the holidays.
Yeah, again, if you look at the actual earnings of drivers and the flexibility, again, it's like an ATM in your pocket. With Lyft, you can turn it on and off whenever you want. And so there aren't any other comparable jobs outside the gig economy where you can get $20 to $30 an hour on average and do it whenever you want. And within the gig economy, rideshare has historically on average had higher earnings than in the other categories. So we'll always work to do better, always work to serve our drivers better than any other company. And we're doing that with different features we're bringing to market, and also a lot of the marketplace tech that isn't seen by the customer or the rider because they just see a simple button to request a ride. But we're building a lot of data science and technology underneath the hood that allows us to increase utilization of drivers to also increase their earnings.
Waymo is now mapping New York City. It's, potentially a step forward for self-driving cars. I understand bikes. We're also seeing a spike there. What are the more interesting trends in alternative and newer forms of travel?
Yeah, so New York City specifically, we own City Bike, which now makes up 40% of all our rides in New York. It's basically a pretty decent sized transit system in its own right. We saw that the bike share business, again, where we have exclusivity in New York, did very well even in the pandemic as obviously an individual open air form of transportation. And that's continuing. We're continuing to get more density in New York with our bikes. We launched Lyft's first, ground up built e-bike, which has been really popular with those that have had a chance to use it. And then on the autonomous side, I think, we're still years off. But it's obviously a category we feel incredibly well positioned to bring to our customers as well.
John, you're a New Year's Eve driver. Every year, are we going to see you out driving again on New Year's Eve? And what sort of traffic are you expecting over the holidays?
Absolutely. Like you said, I drive for Lyft every New Year's. I'll be doing it again this year. And I expect it to be very busy this year.
All right, John Zimmer, president and co-founder of Lyft. Always good to have you. Look forward to that tweet on January 1st. Thank you.
Thank you.
Coming up, women-led startups. Funding to women took a step backward through the pandemic, but now it may be starting to rebound. We'll talk about this and more with Beyond the Billion, a company mobilizing investors who've pledged to fund female-founded firms next. This is Bloomberg.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Women-founded startups were disproportionately impacted by the pandemic. That's according to a new PitchBook report revealing that as deal value increased in the overall U.S. startup ecosystem in 2020, it fell for women-founded companies. Let's talk about the reasons behind this with Shelly Porges. She is the co-founder and managing partner of Beyond $1 Billion, a company serving a global consortium of investors who have pledged to invest in female-founded companies. So, Shelly, the numbers prove true what many of us believe, that women actually backtracked through the pandemic, and especially women entrepreneurs. What are you seeing in the numbers?
So you're very true. It's very true, Emily, what you just said, that 2020 was clearly not a great year for women, for female founders. In fact, we saw that funding dropped by 3% instead of the record year that we had in 2019. Deal count dropped by 2%, even as the overall market increased by 16%, even during the pandemic. So this was clearly a troubling, set of data points. And yet, we're really happy to report that 2021 is a very different story.
How different is 2021? Looking at the numbers, looks like the numbers are going up.
Women are shattering their records from prior years. Women have in 2021 through the first 3 quarters, compared to a full year of 2019, women have increased, funding has increased into female-founded companies by 70% to $40.4 billion, up from $23.7 in 2019. In fact, and that's in contrast to the overall market increases of only 43%. So women are, in fact, bouncing back. We're seeing that, you can see these nice numbers. You see that bounce back there starting in December, coming back at $40.4 billion. We're also seeing exit values increasing by 144% to $53.8 billion, compared to only 102% increase in exit values for the entire market. And finally, in terms of exit volume, again, we're seeing a 12% increase over last year versus a 3% for the overall market.
So progress is progress, and that should be celebrated. But how do we make sure we don't slip back to old ways?
Yeah, that's a really great question. Well, one of the key drivers of this change, of course, is not just that the economy's come back overall, that confidence levels have gone up, that investors are feeling better about where they're deploying their capital. But the key, too, is that we have a really significant increase in the number of and percent of female check writers. So today, there are 15% of all GPs in the United States are women. That's up 3.5% from just 2019, and it's growing faster and faster. In our consortium of over 100 venture funds, we see over 80% of them are women, people of color, or both, and we couldn't be more excited, because we know that when women are the check writers, they generally over-index toward female founders, and female founders know that too and seek them out, in fact.
There's still a huge perception problem, though. Women and women founders are often viewed as a riskier bet, a less safe bet, even though women typically and historically deliver higher returns per dollar invested. How do we close that gap between perception and reality?
Thanks for bringing that up. That's such a critical point that is often lost. As one of our male partners, GP partners, has said, women are the most underrepresented asset in the world. Investing in women is like an incredible arbitrage opportunity. If you care nothing about equity and only care about returns, you've got to be investing in women for the very reasons you just mentioned. Some of the things that we know have to be done. Look, we know there are both personal biases as well as systemic biases in the venture ecosystem. We're not going to fix all the personal biases. That will have to come on its own or by the, persuasion of the outcomes that we finally deliver through female-founded companies. But seeing but what we can do is fix some of the systemic biases, that is, biases that are built into the systems. And three of the top ones are, first of all, ensuring that there are women in the deal flow. You cannot imagine, even among our own consortium, where we've got funds that are pledged to invest more into female-founded companies, when they tell us they haven't managed to do more over a period of time as we track them. We find that they haven't changed their processes. Well, obviously, you've got to change your process. You keep doing the same things over and over, you're going to keep having the same results. So ensuring that women in the deal flow is number one. Number two is ensuring that women are getting through to be considered for due diligence. So being in the deal flow in the open end is one thing. Being in the deal flow in front of an investment committee is yet another thing. We had one big European fund say to us, look, when women come through our doors, they get treated absolutely equally to the men. And I said, well, that's great. So how many female-founded companies have you invested in? And P.S., the answer at the beginning was none. So then I said, well, you may not have thought about what it takes for women to get to and through your doors before they even face your investment committee, even assuming the investment committee is unbiased. So there are many things that we do have to change in order to ensure that female founders are invested in.
So what happens in 2022? Any predictions? Is it a better year for women or not?
We're optimistic about 2022 because we see one of the exciting things that I did sort of mention earlier, that is the increase in exits. In fact, 2021 will be, if we end up the year in the direction we're going now, will be the 11th straight year for female-founded companies to exit faster than the broader market. And as you pointed out, at generally higher valuations per dollar invested. And investors have got to be happy with that, right? And that we see among our own funds that have begun to invest into female founders and or have increased their investments, that they are seeing more and more exciting outcomes. We already have 8 female-founded unicorns in our consortium in the portfolio companies, and we have many others scaling rapidly to really successful exits. So we think that success breeds success. That's what we like to say.
All right. Celebrating the progress here and hope to see more of it. Beyond the Billion co-founder and managing partner Shelley Porges, thank you so much for stopping by and sharing that with us. Coming up, how Levi's is handling the supply chain crunch and bringing on new technology for their products, the iconic American blue jeans brand. And as we head to break, let's check on Etsy. Shares down about 2% after reporting results, giving a lackluster forecast suggesting growth quite hard to sustain. Etsy sales more than doubled in 2020 as consumers turned to online shopping sites through the pandemic. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked about other things. Now that's moving to become mandatory.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back. I'm Emily Chang in San Francisco. The supply chain crunch ain't easing up, and it's affecting virtually every business, including Levi's, the company that literally invented blue jeans over a century ago. I caught up with CFO Harmeet Singh and President and CEO Chip Bergh to talk about how they're powering through the crisis and what they've learned from the pandemic.
If you think of supply chain, think of two broad buckets. One is sourcing, and second is commodity and costing. On the sourcing side, very early on, we said we won't put all eggs in one basket. And so we source across 24 countries. Not from any single country do we source more than 20%. You talked about costs. Given our global buying power, we've already negotiated the first half of the year at very low single-digit inflation relative to last year. The one thing, because the brand's so hot, has been really resonating with the consumers. We've continued to take pricing, even during the pandemic. The brand today has pricing power.
Levi's 2021 full-year revenues are on track to match 2019, fulfilling the company's pledge to emerge stronger from the COVID crisis.
We committed in the middle of the pandemic that when our revenues got back to pre-pandemic levels, our margins would be up more than 2 points, and we've now delivered on that.
But with the virus still weighing on consumer confidence and supply chains and inflation surging around the globe, this is no time for any retailer to relax.
As you look forward over here, I think the biggest question is who's going to take the learnings from the pandemic versus who's just going to fade back to what they did in the past.
I think over time, because of the learnings people have had during the pandemic, there is going to be thinking about how do you globalize your supply chain? Do you concentrate in a few countries? Do you diversify? Do you bring some production home? One of the programs we started a couple of years ago was our FLX program. It's using lasers to finish your denim product. It used to be done by hand. It used to be done overseas. But now we bring in the blanks and we finish it closer to markets. And so we're in the process of expanding that program around the world. So I think people need to just think about different ways of doing it. And I believe technology will play a key role.
And speaking of this new laser technology to finish their denim products, I figured I'd check out how it's done. Take a look.
You can come down here, and we all love our damaged and destructed jeans.
Yes, we do.
So you can
love a little damage.
Click and add damage.
But that wasn't even the coolest part.
So what you customize will come to life.
Okay. So we're going to see my damages on there. Oh my goodness. That's amazing.
You can see it happening in real time.
Like that, a distressed pair of Levi's that just needs one short wash to be ready to wear. This technology is already in use and already delivering results.
We've reduced the amount of water by almost 90% across most of our product line over the last 10 years, saving billions of liters of water, finding new ways to finish the jeans that are just much more sustainable.
How long can you recycle the water for? How long before you have to dispose of it?
Well, with the laser finishing that we use in many of the factories, we can recycle the water virtually endlessly.
So on the right, these are traditional washing machines. They use a lot of water, right? On the left is an ozone-driven washing machine, no water. And so it washes the pants exactly. And using this technology, all our factories now use that technology. And if you go back and look at how much water we have saved since 2011, it's approximately 13 billion liters of water.
That was Levi's CFO Harmeet Singh, President and CEO Chip Bergh, talking to us just down the street at Levi's headquarters in San Francisco. Do not miss the premiere of Chief Future Officer featuring Singh later tonight. That's 9:30 p.m. New York time, right here on Bloomberg Television. And that does it for this edition of Bloomberg Technology. Make sure to tune in tomorrow. We have Qualcomm CEO Cristiano Amon off earnings, as well as Eric Schmidt, Schmidt Futures co-founder, of course, the former CEO of Google. You don't want to miss it. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology, pixels, and binary code with a human and humanizing content.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A very good morning. Welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney. We are counting down to Asia's major market opens.
Good evening from Bloomberg's World Headquarters in New York. I'm Sherry Ann. The top stories this hour. U.S. stocks extend record highs and the bond curve steepens after the Fed signals it's in no rush to raise rates.
Qualcomm's rallies as surging demand for 5G devices brightens its outlook while it diversifies suppliers to deal with the supply crunch.
And the Pentagon sounds the alarm on China's nuclear weapons capabilities, warning its arsenal is expanding more rapidly than previously thought. This is a picture across Wall Street. We are seeing U.S. futures little change, but this, of course, the S&P 500 and other U.S. stocks really rose. We saw those reversing earlier declines after Fed Chair Powell's message that there is a commitment to stay right now accommodative. We saw the S&P 500, the Dow, the Nasdaq 100, and the Russell 2000 all seeing record highs for a second straight session, something that we haven't really seen since January of 2018. We also had data showing that U.S. companies added the most jobs in 4 months. And of course, this ahead of Friday's jobs numbers as well. The dollar index hit session lows under pressure after Chair Powell talked about there being no rush in raising rates. We also had oil under pressure right now at that $80 a barrel level after falling by the most in nearly 2 months in the New York session. We had U.S. oil inventories at the highest since August. Not to mention, of course, we're headed towards that crucial OPEC Plus meeting. Treasury yields also rising to session highs. Take a look at what they've done, because after the Fed announced plans to slow its bond purchase program later this month, we also had the yield curve steepening a little bit. We had break-even rates up as well. So markets, in a way, really not entirely convinced that the Fed does have a tight grip on price gains from now on. And also remember the Treasury announcing the first reduction in its quarterly sale of longer-term debt in more than 5 years. So sort of reflecting that perhaps those borrowing needs from the pandemic spending are starting to diminish. But really, Heidi, was that idea that Chair Powell wanted to emphasize, that really the tests for tapering and rate hikes are different, that one does not necessarily mean the other right away. So those two things need to be really seen in different lights. The Fed also will be discussing how to approach the size of its balance sheet in its future meetings. And really overall, Heidi, it was this sense that perhaps it was sort of a reflection of other dovish messages that we've heard around the world already, coming from whether it's the RBA or the ECB as well.
Yeah, super interesting, because we heard the same from the RBA earlier this week, right, saying that abandonment of the yield target isn't tantamount to the same as saying that that rate hike trajectory is going to get less patient, right? We also heard a similar pushback from Christine Lagarde saying that the ECB is very unlikely to hike rates into next year, really saying that there needs to be patience, that the economic recovery still requires a certain level of support, and that despite faster inflation, that we won't necessarily be seeing that rate hike calendar going into next year.
And of course, we're watching the fiscal space very closely as well, right? Given that we heard the announcement from the Treasury earlier today, and of course, we're watching President Biden's economic agenda. And it seems that the Democrats here in the U.S. might have gotten a harsh 2022 wake-up call, especially from those races in Virginia, New Jersey, and other parts of the country, with voters really flocking towards Republican candidates. So really a warning ahead of congressional midterms in 2022, and perhaps what President Biden can do with its economic agenda in Congress right now. It seems that progressives took hits across the political map on Tuesday.
Speaking of President Biden, he's playing into, of course, his key geopolitically sensitive showdown with the OPEC Plus meeting. We know that the president has been demanding more output when it comes to oil. He wants the cartel to ease up when it comes to some of these restrictions, and to help ease the levels of inflation that we've seen in the energy crisis, right? So President Biden, Saudi Arabia, their allies must really choose the way ahead when it comes to their policy. If we see a rebuttal of the U.S. request, we're looking like a bit of a fight with the White House, which of course is very concerned how energy prices is going to weigh into their economic agenda going forward. Let's take a look at how Asian markets are shaping up on the day after the Fed. This is the picture when it comes to Australia. Aussie futures are up by about 0.5% after what has been a pretty robust week for equities trading. This after, of course, US stocks climbed to that record. The Fed signalling monetary policy will stay accommodative even with the reduction of its bond buying program this month. The Aussie 10-year yield has been holding pretty steady as well. In fact, we have seen really bond markets take a bit of a breather after the incredible price action that really led to the killing off of the yield target policy from the RBA this week. New Zealand, we're seeing a pretty flat start to the trading day, to be honest, in Chicago Nikkei futures as Tokyo comes back online after yesterday's Culture Day holiday. We're seeing 0.2% higher. Let's get more on that Fed decision and the fallout for markets. Joining us now is our Global Economics and Policy Editor, Kathleen Hayes. Kathleen.
Well, you know, Heidi, it was interesting what Jay Powell had to say about policy moving forward. Fed can be patient. Still thinks that inflation is going to prove to be temporary. He doesn't think he's on the verge of getting too far behind inflation that's gotten pretty high. Here's what he said.
I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes, and that's what we need to do. I do think it would be premature to raise rates today. That's not. I don't think that's controversial. Certainly, I don't know anyone arguing for that today. And the reason is that there's still ground to cover to get to maximum employment.
For some analysis, let's bring in Bill Dudley. He's now Princeton senior research scholar, a Bloomberg opinion columnist, and importantly, he was the head of the New York Federal Reserve Bank from 2009 to 2018, another really crisis period for the Fed. Bill, do you agree? You've been warning that maybe the Fed could move too slowly on inflation and have to speed up too much. Is Powell on the verge of a policy error?
Well, we'll see how things evolve. I mean, obviously, if the inflation pressures do turn out to be transitory, then the Federal Reserve has more time. If there actually is more slack in the labor market than suggested by the level of unfilled jobs, then we'll be fine. We just don't know the answer to those questions at this point. I think the important thing here is that the Federal Reserve is making it a choice to really strive to find the maximum level of employment consistent with their inflation objective. And by doing that, there's a risk that they're going to be late.
Well, Bill, you know, you were the chief economist at Goldman Sachs. You worked with a lot of the guys on the bond desk every day explaining the latest numbers. Then you ran the open markets desk at the New York Fed. Very important position, buying and selling securities or overseeing that before you became the Fed Bank president. How would the markets take it? How would the bond market take it if suddenly Jay Powell has to say, well, you know, we're going to speed up the taper so we can get to that rate hike faster? Would that cause the kind of disruption they've been trying to avoid?
Oh, absolutely. I mean, I think that's one reason why the taper is pretty much locked in stone here. I would be very surprised if they sped it up or if they slowed it down. They made it very clear today in their communications. Not only did they announce that what they're going to do for November, they also announced what they're going to do for December. And they made it clear that while they could vary the pace if economic conditions change, that really isn't very likely. So I think we're on a path where the Fed has basically 8 months to assess the inflation outlook, to assess the state of the labor market. And depending on how that plays out, they'll either be able to sit on their hands some more in terms of raising short-term rates, or they'll have to move in the second half of 2022.
Well, as an economist, what is the likelihood that they'll be able to sit tight that long and that inflation will prove to be transitory and this just goes as smoothly as they're hoping?
Well, that's certainly their view, although in the statement today, they softened their views a little bit. Before they said it was transitory factors, now they deem it as factors that are expected to be transitory. So there's a little slightly less confidence in how transitory these factors are. The key thing, though, at the end of the day, is not whether the inflation pressures are transitory or not, but does it get into wages and does it get into inflation expectations? And the most recent data we've gotten on both those things are a little bit concerning. Wages have accelerated more than what's consistent, I think, with 2% inflation. And inflation's expectations, by some measures, are starting to show some upward pressure. But we'll see how this plays out. I mean, the good thing for the Fed, from the Federal Reserve's perspective, is they have 8 months to make a well-considered choice in terms of what's next.
In the meantime, these supply-side issues continue unabated. How difficult is it modelling a policy response when this was quite unexpected and there's a lot of concern